promotion policy as well as important the CASA products introduced by the bank, the features. Questions are sure from that exam. I request all the participants to attend all the classes. Whomsoever is taking the class, please attend the classes. And then CABM Manipal will be conducting a nurture program. Evenings, those program classes also you attend. The more you hear, the more your chances of getting more marks. Okay, that is my personal request to all of you. Okay, sir. Now we are starting the session. So I have few sessions for you. The first program today, I'll be talking to you regarding updation of credit-related matters other than retail lending since last exam. Last exam you had in the month of, if I am correct, 11th November 2023. Before that, from October onwards, what are all the changes that has come? Subsequently, that has been updated in your credit policy and credit risk management policy and the delegation of powers. Those three circulars. So, some other senior faculties will be discussing in depth about the credit policy, credit risk management policy, etc. I will be covering only the changes that has come in the last 1 year in these policies. The latest credit policy, HO Circular 516/2024, and then credit risk management policy, the latest circular is 520/24, and then delegation of credit sanctioning power 539/2024 up to June 2024. Subsequent to that, any changes have come, that also will be covered in this presentation to you today. Okay, let us go. That is, these questions are placed before you are only to give a confidence to you about the exam. So in depth, I cannot prepare all the questions for all the presentations. So I'll be showing the PowerPoint presentation. From there, here and there, 1 or 2 questions will be taken just to give you the confidence to write the exam. Okay, so I'll be switching over between the PowerPoint presentation and the PDF. These things are already uploaded in your CBOA website, sir. First question is, as per HO Circular 520/24, that is a recent credit risk management policy of the bank, which is not correct with regard to ECAI rating of borrower accounts. You know, we have in the bank internal risk rating as well as external risk rating. The internal risk rating model we have, that is portfolio model up to exposure of 2 lakhs. Then we have small value model above 2 lakhs up to 20 lakhs. And then we have manual value model above 20 lakhs up to 2 crores. And above 2 crores, we have CARM model. So, and then wherever the exposure to a party that is above 25 crores, besides internal risk rating, the external risk rating also to be got done by accredited external credit assessment institutions. ECAI means external credit assessment institutions. From them also we have to do the risk rating. Now the question is, that is with regard to ECAI rating. Now let us see the presentation, then we will come to the question. See, ECAI rating, the first time in HO Circular 378/23, some changes have come, that is incorporated in all up-to-date circular. Exposure above rupees 25 crores to be ECAI rated. ECAI means external credit assessment institutions. If it is not done, additional interest to be charged as under. Exposure above 25 crores up to 100 crores, additional interest to be charged was 0.50. Earlier, before the 378/23 was introduced, the additional interest to be charged was only 0.25. Suppose if they give 2 options, the ECAI rating, not rated accounts, the exposure of 25 crores up to 100 crores increased from to this much. So you should be able to write 0.25 to 0.50. That is why I have given the earlier also within the bracket in a different color. Above 100 crores ECAI unrated accounts, the additional interest to be charged is 1%. Earlier it was 0.50%. Who can permit ECAI rating waiver in Canara Bank? Executive Director CAC. You know, CAC means Credit Approval Committees. So EDCAC is the authority to waive ECAI rating. Even in cases where ECAI rating is waived by specific authorities, additional interest as above to be collected unless specifically permitted by ECAI rating waiving authority. So this additional interest to be collected until otherwise it is permitted by EDCAC not to collect the additional interest. The waiver of ECAI rating is permitted till the next review or renewal. Then who are all the, that is, I told you, know, the external credit assessment institutions accepted by the bank for domestic rating, domestic loans given to the domestic units and loans given in hours abroad. So ECAI accepted by the bank for domestic rating, Credit Analysis and Research Limited, CAR, CRISIL Rating, CRISIL, India Ratings Limited, formerly Fitch Ratings India Private Limited, ICRA, then Acute Ratings and Research Limited, Yestoil Semira, Informix Valuation and Rating Private Limited, Informix. As per RBI guidelines, ratings by Brickwork Rating India Private Limited is not valid from 12/10/2022. This question was asked last time for 3 to 4. So which is the risk rating? So RBI has told from which risk rating, domestic risk rating should not be accepted from which risk rating company. So the answer for that question was Brickwork Ratings. However, now recently RBI has relaxed rate. That has come in HO Circular 608/24. Your last credit risk management policy was 520. Now in 608, the updation has come for the Brickwork. So fresh rating from Brickwork Ratings India Private Limited for bank loans not exceeding 250 crores can be accepted with effect from 10/7/2024. When you wrote the last exam, you should not be accepted. Question also has come from 10/7/2024. It can be accepted only for exposure not exceeding 250 crores, about 25 crores up to 250 crores. Only you can accept from Brickwork Ratings domestic rating. So all others you can accept irrespective of the exposure above 25 crores. Then international rating agencies. There are 3 international rating agencies: Fitch Ratings Limited, Fitch, Moody's Investor Service Limited, and then Standard and Poor Rating Agencies Limited, that is S&P. So here the change is, so Brickwork, that is Ratings India Private Limited, again has been permitted by RBI. Bank is also taken into account. Exposure up to 250 crores, risk rating can be done by them. It is also come in the list, but only up to 250 crores. The earlier side, which are all the ratings, and the first slide is what is the additional interest to be paid if the ECAI rating is not done, and who is the authority to waive the ECAI rating in the bank. Okay, sir. Then, so let us see the questions now. Let us see the question. You will get an idea. As per HO Circular 520/24, which is not correct with regard to ECAI rating of borrower accounts. Exposure of 25 crores and above to be ECAI rated. For exposures of above 100 crores, if not rated, additional interest of 1% to be collected. Waiver is valid till next renewal or review. EDCAC is the authority to waive ECAI rating. So which is not correct. So you see point number A. Exposures of 25 crores and above, that is wrong. Exposure of above 25 crores. So for question number 1, the wrong answer is, which is not correct. You have to tick answer in your exam as A. The correct answer for A is above 25 crores. Then point number 2, question number 2, you see, tick the odd man out. So odd man out means which is wrong, which is not correct. Same, odd man out, instead of asking which is not correct, which is wrong, the option the examiner may give you, tick the odd man out. CAR, CRISIL, ICRA, Informix, Fitch. All these things are risk rating agencies as far as approved by our bank, accredited by Reserve Bank of India also. But you see, CAR, CRISIL, ICRA, Informix are domestic risk rating agencies, whereas Fitch is the international risk rating agency. So tick the odd man out. Answer for the question is D. Okay, if you know the risk rating agencies, and if you know for which they are doing international or domestic, you'll be able to answer the question. Similarly, here, once they have brought here CAR, CRISIL, ICRA, Informex, and they put CBIL, that is CBIL or Experian. So there you have to remove that Experian or CBIL because they are not risk rating agencies. They are credit information companies. Like that, you should be able to understand and able to answer the question. Okay, now let us go. Now, that is a brief review about the internal risk rating and external risk rating. So when risk rating to be done, sir? Risk rating to be done before a takeover of a loan or before sanctioning a loan. Okay, this is one of the criteria. Why risk rating is done? Risk rating is done to find out the delegation of credit sanctioning power, and risk rating is done to fix the pricing also. So in all cases, internal risk rating to be done. So then only external risk rating to be done. So wherever external risk rating to be done, it has to be got done. And invariably, whether external rating is done or not, internal rating to be done. So internal rating, I told you there are 4 models in the bank today: portfolio model, then small value model, then manual value model, and then CIRM model. Okay, there are various concepts of that. So that it has to be done. Now, whenever, so when it has to be done before sanctioning a loan or before takeover of a loan. Not only that, every year, based on the audited balance sheet of the company or audited balance sheet of the respective concern, risk rating to be done. It is an ongoing exercise. Let's assume you are done a risk rating for a borrower account last year, wherein you are graded low risk borrower. Okay, accordingly, the delegation of credit sanctioning power as well as the pricing has been fixed. When you do the periodical next risk rating, let's assume the borrower slipped from low risk to that is moderate risk.
My planning for next month.
So the borrower has slipped from low grade to moderate risk.
Kindly mute everybody.
So here, what to be done? So here that is, and so normally that is the pricing has to undergo a change. And if the delegation undergoes a change, the file will be transferred to the next higher authority. Now, in this HO Circular 349/23, what they told, whenever a risk rating is downgraded to a borrower, either internal or external rating, additional interest also to be charged till next renewal. So additional interest also to be charged and additional collateral also to be brought out by the party. That question we are going to see. So 349 is the base circular. At that time, the circular.
Sir, there is some technical issue, I think.
Okay. Am I audible now?
Yes, sir. You are audible, sir. You are audible, sir.
Yes, sir. Yes, sir.
Yes, sir.
Shall I continue?
Continue, sir. Yes, sir. Yes, sir.
Yes, sir.
Sir, you continue, sir.
Okay, please. Okay. So now, as per the from HO Circular 349, that was also a risk credit internal risk rating policy of the bank. There, that some changes have come with regard to whenever the risk rating, periodical risk rating is downgraded.
Sir, 1 minute, sir.
It is up.
Sir, excuse me, 1 minute.
Yes.
Sir, one Mr. Santosh is frequently trying to share his screen. I don't know why. If you want to take class, you can try somewhere else. It is CBOA class. Do not disturb this class. And I have requested everyone to mute the video. About 20 to 30 people video I have stopped. Even now, some people are kept to open their video. You are sitting in your house with your whatever usual dress. Why you want to display there? Please stop your video. And everybody is unmuting. I don't know why. You don't have to talk here. Only Mr. Jagennnath sir will talk here. I have to be very rude here. Please. Sir, sorry, sir. Please continue.
Okay. Ladies and gentlemen, boys and girls, you're all that is highly educated. That is, please maintain the decorum of the class. Okay, so I am staying away. So I am 10,000 kilometers away from Chennai or India. It is early morning over here. Sun has not yet risen. I got up from the bed. That is taking class for your sake. Okay, please keep as what Mr. Ananthakrishnan is telling. Please follow the guidelines. Okay, sir. So now that is a downgradation of risk rating or in upgradation of risk rating. Upgradation of risk rating we'll see in the next slide. Whenever there is a downgradation of risk rating, either internal rating or external rating, so additional interest to be charged and additional collateral also to be brought by the party. That was first time brought out after your last exam around 349/23, and all those things are updated up to 520/24. So what these circulars say, let us see in the nutshell. Immediately on receipt of external rating or internal rating, based on the audited annual accounts of the borrower, the account shall be reviewed. All of you know. In case of deterioration in the risk rating grade, I told you, low to moderate or low to the moderate to the high risk or normal risk, etc., whatever risk you are having, the pricing, including the concession, shall be reviewed to examine the need for continuation or withdrawing the concession if any permitted. However, till the time the process of review of pricing is completed, additional interest over and above the contracted rate to be levied. So whenever there is a risk rating downgradation, some review and all various authorities will do. Till such time, some additional interest to be charged to the party. What is that? We will see. What is the additional interest? So downgradation of risk rating and additional interest to be charged. So suppose if you external rating, first let us see external rating, then we'll come to the internal rating. Downgradation of risk rating external, additional interest to be charged. So external credit assessment institutions will give the rating like this: AAA, AA, BBB, BB, B, C, like that they will give. Okay, whenever the earlier rating was AAA, when it is brought down by one notch, NOTCH, one notch means by one downgradation from AAA to AA, it brings the additional interest to be charged is 0.50. On the other hand, from AAA, it has brought down by more than one notch, whether it can be A, BBB, B, BB, or C, whatever it is. Additional interest to be charged is 1%. On the other hand, from AAA, it is new rating has come to D. So the additional interest to be charged is 1.50. Like that it is there. Whenever there is one downgradation from the existing rating to other rating, the additional interest to be charged is 0.50. If it is more than one downgradation, the additional interest to be charged is 1%. If it is straight away from one rating, it has brought down the default rating where you should not give any loan at all. So at that time, the new rating is D. Everywhere it has to be charged to 1.50. Keep that in mind. One notch down, 0.50, and you should know what is a notch. AAA to AA, AA to A, then BB, BB, B, C. So whenever one notch down at 0.50, whenever more than one notch is down 1%, whenever it slips to D, you should charge 1.50. That was told up even in 258/24. So in 477/24, what they told, in all the cases, if it becomes unrated, so it is downgradation of risk rating. So what do you mean by unrated? We'll see in the next slide. In all the cases, if it becomes unrated, the exposure becomes unrated, additional interest to be charged is 1%. Okay, that was told in 477/24. So I told you downgradation, what is additional interest to be charged? By one notch, 0.50, by more than one notch, 1%, and then to D, slippage to D, 1.50. In all the cases where the exposure becomes unrated, the additional interest to be charged uniform is 1%, which was told in 477/24. That is reproduced in 520/24 also. Then, what do you mean by unrated? Customers having ECAI rating withdrawn, suspended, expired, or without bank's name and exposure details in respective press release issued by the ECAI by rating agencies are to be rated as unrated exposure. So suppose they may ask the question, what is an unrated exposure, which is not correct with regard to unrated exposure. So ECAI rating withdrawn, ECAI rating is suspended, ECAI rating is expired, ECAI rating not done, various options given. So that is why I given. What do you mean by unrated exposure? ECAI rating withdrawn, suspended, expired, or without bank's name and exposure details in the rating, in the press releases, they are called unrated exposure. So whenever the ECAI rating, so you have to continuously monitor the ECAI. So you continue monitor what is the rating is given, whether it is unrated, what is happening, continuously you monitor. So if it has become the unrated exposure, then the additional interest to be charged is 1% more than the normal rate. That is what it is told here. Now, suppose that is wherever the part I told you, wherever there is external rating above 25 crores, besides internal rating, you will do external rating. Then if there is exposure is less than 25 crores, you will do only internal rating. So whenever there is an internal rating, whenever there is downgradation of internal rating also, additional interest to be charged to the borrower. So what is additional interest? So the internal rating is a must. It is based on the audited balance sheet. Okay, so if the existing, similarly here also, by one notch, if the internal rating comes down, additional interest to be charged is 0.50. If more than one notch it has comes down, the additional interest to be charged is 1%. If it goes to D, CNRD, we call it as, I will in next slide I have shown you what is CNR1, CNR2, etc. If it goes to CNRD, the additional interest to be charged to the borrower is 1.50. I told you above 25 crores, you will have internal rating and external rating. In that case, which based on what you have to charge additional interest, wherever internal rating and external rating is available, additional interest to be charged based on the external risk rating downgradation, not based on the internal. Wherever internal rating is only is there, additional interest to be charged based on the downgradation of the internal risk rating. See, this is the, I told you by one notch, this is additional interest, by two notch, internal risk rating 1% and CNRD 1.50. What is CNR? Suppose if they ask you in the exam, you should not miss it. CNR4 means it is low risk 2. That is why I have given the table. CNR1 to CNRD, what is, we call the nomenclature, what we are having is minimal risk 1, minimal risk 2, low risk, then normal risk, you have moderate risk, high risk, etc. And then default grade. D is the default grade, CNRD. So this also you should know. If they ask, you should not miss it out. That is why I given. Most of you may be knowing it. Then, so I told you, if both internal and external ratings are available, additional interest, etc., to be charged based on the external rating. If external rating is not available, additional interest to be charged on the internal rating downgradation, if it is downgraded or not downgraded. So I told you what is the additional interest to be charged whenever there is downgradation by one notch, as well as by that is more than one notch, and then slipping to the default grade also. If downgraded, what is additional interest to be charged? 1%, 1.50%, and then 1.50% because that is 0.50, 1%, 1.50% we have seen. Now, their additional interest. If the downgradation is by more than by two notches or more, that is from AAA instead of going to that is next to AA, if it goes to A. Similarly, from low risk, it straight away instead of passing through normal risk, it goes to moderate risk internal rating. If downgradation by two notches and more, so besides charging the additional interest, something you have to do. Let us see the slide. 25% additional collateral in the form of immovable properties or by any other approved securities to be obtained within 6 months of downgradation. When it is only when downgradation by two notches or more. The additional interest shown in the table to be charged till additional collateral is obtained. Suppose by two notches downgradation, that is 1% to be charged. Besides that, you have to bring 25% additional collateral within 6 months. If he brings additional collateral within 6 months, the 25%, then the additional interest, what we are talking about 1%, need not be charged. Okay, on the other hand, if he does not bring the additional collateral of 25% within 6 months of two notches downgradation, if additional collateral is not obtained within 6 months, additional interest of 1% over about the additional interest shown in the table to be charged. So in the table, I told you for downgradation by two notches or more, 1% additional interest. So that you have to charge, he brings collateral of 25% within 6 months of downgradation. So if it does not bring within 6 months of downgradation, besides the 1% which you are charging already, you have to charge another 1% also. That means 2%. In all the cases, the concerned sanctioning authority can reduce the additional interest, additional collateral, etc. That is left to the sanctioning authority. Then, if downgradation by one, so now whether that is related to that. That is, this is told in HO circular 801/23. That also come after last exam. It is a consolidated circular on the valuation. Bank is having a method of valuation of fixed assets, valuation of what you say is stock, inventory, and book debts. Bank has a procedure for valuation of the NPA accounts also. Now, whenever the risk rating is downgraded, whether revaluation, so additional rate of interest, etc., to be charged. That but what we have seen in 801/23, they also told whenever there is a downgradation of the risk rating, so revaluation of the property to be done. When the asset valuation to be done at the time of sanctioning the loan or before taking over, etc., we do the valuation. And because of fixed asset, we do valuation once in 3 years, and in the case of stock and inventory, depending upon the loan quantum, depending on the risk grade of the borrower, you will do the risk rating. Valuation. I'm talking about valuation. In the case of valuation, in the case of fixed assets, normally once in 3 years. And in the case of stock, inventory, and book debts, you will do valuation depending upon the risk grade of the borrower sanctioning of the loan. All those things are 801/23. And that is also told in the credit review and monitoring policy 64/2024. The concerns various faculty will be teaching you. That is with regard to that is valuation of the property. Now, that is when you have to do valuation. So I told you what is the periodicity of the doing the valuation. So when you do the valuation for your retail lending loans, we will do the valuation for the retail lending loans. That is wherever it's a prime security or collateral security, wherever it is taken and land and building loan is given, we will do revaluation once in 5 years, provided the liability in the account is 50 lakhs and above as at the end of previous March. That is with regard to retail lending valuation. Periodical valuation, I am telling you. Again, I am telling, in the case of retail lending, periodical valuation will be done. So that is once in 5 years when the liability in the account is 50 lakhs and above as at the end of the previous March. That is the guideline. With regard to agriculture, separate guideline is there. Okay, agriculture revaluation is told in HO circular 7/2023. Please go through the circular once. 7/2023 talks about valuation of agricultural land and revaluation of agricultural land periodicity. So retail lending with regard to valuation, it is mentioned here, and then 801/22 other valuation. So if downgradation by 1 notch, no need for fresh valuation if the previous valuation report is not more than 6 months old. So if the previous valuation is not more than 6 months old, you need not do any revaluation wherever there is the downgradation of risk rating by 1 notch. Otherwise, within 3 months, you have to do revaluation. If downgradation is by 2 notches, then fresh valuation to be taken within 3 months of downgradation, irrespective of the date of previous valuation. So these 2 points you should know. If downgradation by 1 notch, and if the previous valuation is not more than 6 months old, you need not do revaluation. Otherwise, you have to do within 3 months. If the downgradation is by 2 notches, irrespective of the period of the existing valuation report, immediately revaluation to be done. It is applicable both for stock, inventory, as well as the fixed assets of the bank. Okay. Now, so we have seen whenever there is a downgradation, what is the additional interest to be charged and what is the additional collateral to be obtained. If not obtained, what is the additional penalty over there? Then revaluation of the assets also we have seen. Now, when that is up, so that is with regard to irrespective of the exposure, whenever there is downgradation, either internal rating or external rating, you have to charge additional interest and all other guidelines to be done. If it is not waived by the sanctioning authority, that is okay. Now coming to upgradation. Whenever there is upgradation of the risk rating, either in internal rating or in external rating, whether any concession to be given to the borrower. First time that has been brought in HO circular 757/23, and it is updated in the latest policy, credit risk policy 520/24 also. Why I am giving all those things? In detail, something if you want, you can refer those circulars also. You have around 1 month time for your exam. If upgradation of rating takes place, interest concession to be given as under external rating upgradation from AA to AAA, from AA to from okay, then from AA to AAA. That's next gradation. Beyond that, there is no upper gradation. From A to AAA, or from A to AA, like that it is given. So here it is not uniform, 1% or 0.50. You should know the numbers. You should know the numbers, and you are given. If it is upgradation of the internal rating from some slabs to one risk rating to higher risk rating, what is the interest concession to be given to the borrower with regard to external rating? Next slide. So with regard to internal rating, Similarly, if it is from CNR4 to CNR1, like that it comes, etc. Here and all, you are not going to give any interest concession. So if it is there, because CNR4, CNR1, CNR2, if it becomes CNR3 also, there is no additional interest concession. Like that it is there. So these are all the numbers. You should know the numbers. So I cannot, there is no need for me more explanation over that. That means whenever there is upgradation of a risk rating, either internal rating or external rating, interest concessions can be given to the borrower whenever risk rating is upgraded in certain risk rating cadres. Okay. Now, next point is, there I told you, whenever there is downgradation of the risk rating, irrespective of the exposure, additional interest to be charged or additional collateral to be obtained. Those things we saw. Here, the interest concession, whatever to be given as per the slide, can be given only if the exposure is above 7.50 crores. If the exposure is above 7.50 crores only, whenever there is upgradation of the risk rating, you can give interest concession. That means that is above 7.50. So whenever that is, portfolio model, small value model, manual model, or CARM model, up to 2 crores, above 2 crores we are doing. No, in all the cases you cannot give, only if the exposure is above 7.50 crores. You read the slide. Whenever there is an upgradation in the external rating or internal rating of the borrower, for exposures above 7.5 crores, which are subject to rated under CARM model. Above 2 crores, you have to do it under CARM model, internal rating, or eligible to be rated by ECAI. Above 25 crores, you will do under ECAI rating. Concession interest rate may be given by the branches officers only if the exposure is above 7.50 crores. The ultimate rate should not fall below RLLR or MCLR. All sanction conditions should be in place. The account is regular and all other conditions are there. Okay, sir. Where both internal rating and external ratings are available, benefit of reduction, the rate of interest shall be given only on upgradation of external rating. That I already told you. The concession shall be valid till next review, renewal, reset of the credit facilities. Okay, sir. Let us now see the question. Let us see the question now. We'll be able to answer. Now, as per HO circular 4, so the first two questions we have seen. As per HO circular 477/24 at 520/24, if a ECAI rated account becomes unrated, what is the additional interest to be charged? All of you know, answer is B. So ECAI rating, downgradation, and then unrated. What is unrated also I told you. In those cases, the additional interest to be charged uniform is 1%. Then question number 5. Which is correct with regard to valuation of HO circular 801/2023. I think I have not covered here. Let me see whether I have covered that in the presentation. Otherwise, I will tell you. There is no. Okay, it is here, sir. Okay, we'll go there. So, ECAI rating, I told you. Now, valuation, a small change has come in 801/23. It is the practice of the bank to appoint more than one valuer in respect of valuation of assets of that is having high value. Bank shall obtain minimum 2 independent valuation reports from 2 empaneled valuers in respect of loan accounts where the value of individual property obtained as collateral for loan is ₹5 crores and above. So if the value of the property which is taken as the collateral for a loan, land and building, if it is if the value of the property for loan is 5 crores and above, you have to take 2 independent from 2 different valuers, approved valuers, the valuation. Earlier, before 349/23 was introduced, it was the value of the property is 10 crores and above. Now it is reduced to 5 crores and above. Then when the value differs, so one valuer is giving one value, another valuer is giving another value. Which value we will take? That is defined in 801/23. So far what we have been doing, at the time of sanctioning the loan, whenever the value is differs, we will go by the lesser valuation. Now what 801/23 says with regard to which value we have to take, that we will see. So one question is, when you will take 2 valuation, when the value of the property is 5 crores and above, 2 valuation to be taken. Earlier it was 10 crores and above. That is one point you get from here. Next point. So when the value differs, which value to be taken for sanction processing the proposal? first ascertain whether both the reports use the same basis for valuation. Let's not go in depth on that. Whether both the valuation uses the same basis or both the valuation uses different basis. That we are going to see. If basis for valuation is different, if both the valuer has not taken the same basis, if the basis for the valuation is different, then average of both the valuations ought to be taken to arrive at the value of the property. Okay. If basis of valuation is the same, basis of the valuation is the same, and the variation is within 15%, average of the two valuation to arrive at the notional value to process the proposal. So when the valuation is different and when basis of the valuation is different, take the average. When the valuation basis is the same, when the valuation is different, value is different, if the value difference is within 15%, take the average. Third point. If the basis is the same, but the difference in the value is more than 15%, then bank will get the valuation from an empaneled A category valuer and the lowest of the three to be taken. Okay, that is the point. So that is, if the basis is the same and the difference in the value of both the valuation is more than 15%, then bank will take the valuation, third valuation from an empaneled A category value. What is the A category? It's given 801/23. Empaneled A category valuer and the lowest of the three to be taken. Cost of the third valuation to be borne by the bank. So bank to examine the valuation of the highest one and call for explanation. If the explanation is not satisfactory, then bank takes steps to the deletion of the panel value from the panel. That is the change in valuation in 801/23, sir. Okay. Some more points also in the circular we will see. If a question comes, you should not leave it. In respect of valuation of fixed assets, current assets, including book debts, it is to be ensured that at least one assignment is allotted per panel valuer. There shall not be any valuer stock auditor who has not been given any assignment during the financial year. Circles, okay, that you leave, not a problem. Here, this one change has come. So sometimes they are suddenly asking. Maximum number of valuation work in respect of current assets. Current assets, you know, that is by inventory, book debts, and stocks. Maximum number of valuation work in respect of current assets that can normally be entrusted to a stock auditor in a financial year is 6. Last year, it was only 3. So for a stock auditor, so normally that is bank can entrust in a financial year maximum valuation only in case of 6 cases. So earlier it was 3. Any deviation in this circles to report to credit policy section RMB. No such guidelines for fixed asset valuer. So here you have to give that is a maximum. You can give only 6 to a valuer in respect of stock audit. Whereas in the case of fixed asset, no such guideline. So earlier, last year for stock audit, it was only 3. Maximum we can give. Now it is enhanced to 6. So the examiner sees the numbers in your circulars or in your policy. He sees the numbers. Many of the questions will relate to the numbers only. So some people used to ask, what is the numbers we should remember? We can see the circular. That is different. Examiner does not know. So examiner is assigned with the circulars and other things. The management gives what types of questions to be asked to him. So he picks up, you see the previous year's questions, which Mr. Ravi Kumar has already given to you. There, many of the answers, if you see, is related to the numbers only. So this number you see, that is why the earlier also I have given in different color. If they give 2 options, increase from dash to dash, you should be able to write from 3 to 6. That is why I have given here, sir. Okay. So we will see now question number 5. You will be able to answer the question number 5, you see. Which is correct, which is correct they are asking, with regard to valuation as per HO circular 801/23. Bank to obtain 2 valuation reports from different valuers in loan account where the value of immovable property taken as collateral is 5 crores and above. That is correct. If the basis of valuation is the same and if the value differs to the extent of more than 15%, then average of the two to be taken into account. Point number C. Maximum number of stock audit to be entrusted to stock audit financial is 6. So point number D. A and C are correct. A to C all are correct. So you have 5 options, A, B, C, D, E. So your option is, you see here the correct answer should be D. A and the C should be correct. Let us see. So bank to obtain 2 valuation reports from 2 different valuers. Okay, that is correct. And B is not correct, you see. If the basis of valuation is the same and the value differs to the extent of more than 15%, then average to be taken no. If the basis is the same and the valuation differs within 15%, then only average to be taken. If it is more than 50%, A category valuer to give the third valuation. So B is not correct. So A is correct, B is not correct. Let us see whether C is correct. Maximum number of stock audit to be entrusted to stock audit financial is 6. That is also correct. So A is correct, B is not correct, C is correct. Answer number A and C are correct, and E, A to C all are correct. So your option for this question is D. If you know 801/23, you can answer this question. So for question number 5, answer is D. Okay, then let us say, sorry, okay. With regard to guidelines, whenever that is, we entrust the valuation to third-party valuers. So valuers, the stock auditors, many people we are having. So we give the job to them, surface valuers. Whenever, so we come across the third-party entities involved in your fraud, in convenience with the borrower or something, they give inflated figure with regard to valuation, what to be done. So whether we have to revalue, for example, gold loan. If we find out that is gold loan packet is not the correct gold, spurious gold, immediately we go for 100% revaluation of the gold packets. Okay, we do. Like that, whenever the third-party valuers give valuation report, and if bank comes to know that they are involved in some fraud, then in that case, what to be done with regard to the valuation given by them? They're already, for long back, they have given valuation. Recently, they would have given valuation, stock audit, inventory audit, or book debts, or whatever you say, fixed assets, what to be done. That is a guideline which is given in 801/23. Guideline Institute of third-party entities involved in fraud. Third-party entities undertaking stock audit, lenders, independent engineers, all those things, somebody will talk to you in credit review and monitoring policy number 64/24. Lenders, engineers, techno-economic viability consultants, surface evaluators. So whenever you find out fraud involved in these things, so revaluation to be done in all the accounts, revaluation of the assets to be done in all the accounts that such third-party entities give the valuation in the last 1 year. So if these people, when they do the valuation, if they give the valuation and if there is some fraud you notice with regard to third-party entities, in these cases, whatever valuation report given by them in the last 1 year, you have to go through, get it done by a revaluation by a different panel valuer. In respect of fixed assets, this is with regard to these things. In respect of fixed assets, plant and machinery, land and building, etc. In respect of fixed assets, revaluation to be done. If these parties are involved in some forgery, etc., revaluation to be done in 10% of the loan accounts, that valuation to be done by such third-party entities in the last 6 months. So here, in the last 1 year, revaluation to be done in all the cases. Here, revaluation to be done only in the case of 10% of the valuation reports given by these people with regard to fixed assets in the last 6 months. Beyond 6 months, you need not worry. This is the change which has come in 801/23. Okay, that also I want to done you. Okay, then so 2-3 points are also there. That also miss out. If the valuation to be got done by a valuer empaneled for one circle by another circle, permission from RM being HO to be obtained. That is very important. So suppose if 2 circles are in the same state, for example, you take Tamil Nadu, we have a circle, Madurai circle, we have a Chennai circle. Chennai circle empaneled some valuer, and then Madurai circle also empaneled some valuer. Whether those valuers can be used in that case. So first point is, if different circles empanelment, the other circles want to use that panel valuer, then RM section's permission to be obtained HO. This is not applicable for circle officers coming under the same state. I gave an example. But the maximum number of entrustment of such valuation, for example, Chennai circle branches, if they want to give the empanel valuation to the Madurai circle because of the same state, the maximum number of entrustment of such valuations for fixed assets and current assets from the neighboring circle in the same state not to exceed 3 in a financial year. So different states, you get the permission, different circles, different states that get a permission from RM being HO and entrust the valuation. Within the same state, different circles, you can entrust, but maximum should not exceed more than 3 in a financial year, both fixed assets and inventory. Okay, sir? Okay. Now, that any question is there with okay. So question number 6 we will see, sir. Question number 6, which is not correct with regard to periodical valuation of immovable property other than retail lending and agriculture. Okay, then we'll see the this question will come after the slide only. Let us see the slide. So now we have seen with regard to changes in the valuation of fixed assets and inventory as per HO Circular 801/20. The changes only we are seeing, sir. That is existing things, this I have not touched. Okay, somebody else will be talking to you, or you can go through the circular. Valuation of the vehicle. So you know that is we have a written down value, that is depreciation to be taken into account, while vehicle has to be valued. So first in HO Circular 349 it has come, subsequently it has updated here. So insured declared value as per the latest valid insurance policy or depreciated value by applying the return down value method at 20%, whichever is higher is to be considered for the valuation of the vehicle. So far, the valuation of the vehicle before the HO Circular 349, so by applying return down value method at 20%, so straight away we are taking. Now in 349, they told, insurance companies, whenever you go for insurance, the sum assured, they have that is insured declared value. So the sum assured for the vehicle, so they have insured declared value. So based on that, they will fix the premium. You take this existing insurance policy, live insurance policy, you take this value, or you find out as per the return down value of depreciate 20%, what is the value, whichever is higher to be considered for the valuation of the vehicle. This is as per HO Circular 349, first time introduced in the bank and updated in 520 also. Then valuation of immovable property. Other than retail lending and agriculture, I told you valuation of fixed assets in the immovable property in respect of other loans to be got done normally once in 3 years. That is assuming that account is not NPA. So once in 3 years. So for retail lending, what to be done, I already told you. For agriculture, please refer 7/2023 for agriculture valuation of the agricultural land with structures also. If I want, I will also tell you here. So you will see it later. So normally in the case of retail lending and other than retail and agriculture, valuation of the fixed assets, immovable property to be got done once in 3 years, land and building. Circulate CAC can reduce the frequency to allow concession rate of interest on additional interest. So in your MSME products, so loans can be sanctioned, more loan can be sanctioned, or interest concession can be given taking into account collateral value, or some of your scheme guidelines are like that. So we are not going, some MSME policy, somebody will tell you. So in regard to some of the MSME loans, so that is based on the value of the property. So concession in the rate of interest or higher quantum of the loan or lesser quantum of the loan can also be sanctioned. So what the parties will do, normally we told valuation is to be once in 3 years. After 1 year is over, party will come and tell my value of the property has increased, sir, in that area. Guidelines value has increased. You please do revaluation and give me concession in the rate of interest or increase the higher quantum of loan for me. In that case, who has the authority to do it? Normally once in 3 years only. If the parties want to get a more quantum of loan or interest concession, so lesser frequency also, that is valuation of the fixed asset, immovable property can be done. So what is the guideline that has come in 349 and then subsequently updated? If valuation is carried out at a frequency less than 33 months, earlier it was 36 months. Earlier in the previous circular, if the valuation is carried out at a frequency of less than 36 months, now it is revised to, if the valuation is carried out at a frequency of less than 33 months, okay, value of property to be taken, you have to take a revised valuation. If the valuation is done with less than 33 months, then you have to take 85% of the latest valuation report to be taken and valuation to be given by a valuer other than the one who have given the earlier valuation. Okay, so to give interest concession and to give that is increase in the value of the property additional loan, valuation can be done at a lesser frequency, less than 3 years also. If the valuation is done at less than 33 months, then it can be done. In that case, you should not take the full value of the revised valuation report as the value of the property, only 85% of the value of the property to be taken. And who is empowered for that? So that is circulate CACS. circulated CAC can reduce the frequency to allow the concession interest rate and for additional interest. So this is less than 33 months. Now let us see the question. Question number 6. So which is not correct with regard to periodical valuation of immovable property other than retail lending and agriculture. Valuation to be done once in 3 years, correct. Circulated CAC can permit the periodicity for lesser frequency, correct. If valuation is carried out at a frequency of less than 33 months, then 85% of the value of the latest valuation report to be taken. That is not correct. Okay, question number 6. Your question number 6, which is not correct. Question number 6, which is not correct. So answer is C. So if the valuation carried out at a frequency of less than 33 months, then in that case, only 85% of the valuation to be taken. If it is more than 33 months and less than 36 months, in that case, you can take full value. So only 33 months. So 85% of the value to be taken. Question number 6, that is answer is C, which is not correct. Okay, sir. So these questions are only to give you confidence. Okay. So valuation respect of loans to commercial real estate, CRE exposures, But here also, normally once in 3 years, valuation to be taken. But in Issue Circular 378, subsequently reproduced in 516, that is credit policy of the bank. So if the account appears in SMA 1, shows any early warning signals or occurrence of any adversities affecting the marketability of the property, valuation shall be obtained once in a year. So in the case of a commercial real estate exposure, it is a dangerous exposure. So normally valuation is once in 3 years, but the account appears in SMA 1. You know what is SMA 1? Overdue more than 31 days up to 60 days. Okay, that is SMA 1. So if the account appears in SMA 1 or shows any early warning signals of the account going to slip to NPA or occurrence of any adversities affecting the marketability of the property, valuation to be got done once in a year instead of once in 3 years. Okay, they'll give when valuation to be done, A, B, C, D, with regard to valuation, which is the correct option, which is the odd man out, which is not the odd man out. So many options are there. If you know the subject, you can answer, sir. Then valuation. So this is also given in 378, updated in 516. Valuation respect, there is a small change here. So these are all only the changes. Valuation respect of NPA accounts, all type of loan, whether agriculture, non-agriculture, retail, MSME, or corporate advance, wherever it is, when your account slips to NPA, when valuation to be got done. So first, ensure the assets are available. You have to take up with the higher authorities or assets are available, we'll do for valuation. So branches have to certify that assets are available, it is worth for doing the valuation. Allow for a normal cooling period of 1 quarter for upgradation. Allow for if the account slips to NPA, allow 1 quarter for upgradation of the account. If the account does not get upgraded, if continues to be NPA, fresh valuation to be taken within 6 months of the account turning NPA. That is existing. So up to point number 1, 2, 3 are the existing guidelines before 378 has been brought into. After 378 was brought into, the additional points are included. What is that? So first, ensure that assets are available. Allow for 1 quarter cooling period. If the accounts are not upgraded, get the valuation done within 6 months of the account turning NPA. Okay. This is applicable only if the unexpired period of the existing valuation is 6 months or more. This is newly introduced in 378. So this is applicable, that is doing the valuation within 6 months of the account turning NPA after that is cooling period. This is applicable only if unexpired period of existing valuation 6 months or more. If the existing valuation already completed 3 years, when the account is classified NPA, valuation to be taken immediately and then once in 3 years. Okay, so these two are the recent guidelines with regard to NPA accounts turns into NPA, whether immediately we have to take valuation or when to be taken to valuation after allowing the cooling period of 1 quarter. Okay, so for provisioning, realizable value of the security given in the valuation to be taken and it has to be updated in BAM 74, BAM 64, whatever it is in your CBS fast path. So this is because only when you update the value of the property in the appropriate fast path, that is for giving provision as substandard or doubtful, for doubtful first year, unsecured minus 25% plus 25% on the value of the property, etc., etc. The provision is given. You have to update the value after doing the valuation as per this guideline. Then you have to update the value for taking provision and the realizable value of the security to be taken for giving provision in the appropriate fast path. Okay. Then, so what we have seen now, so we have been seeing the valuation. Forget about the other valuation. We have seen the valuation of the vehicle. What is the recent insured declared value? One concept has been brought, and then if the valuation is done less than 33 months, circulated CAC can permit. In that case, you can take only 85% of the value of the property. That also we have seen, and then we have seen in respect of a commercial real estate exposure, when revaluation normally once in years, when once in 1 year you have to do that also we saw, and NPA accounts we saw the changes in the valuation. Now with regard to that is now next is with regard to we'll classify an account as high risk account based on certain nomenclature. Okay, so certain what you say risk rating is being done with various value models depending upon the score the borrower has got, the exposure has got. We'll classify as low risk, normal risk, moderate risk, or high risk. In HOS 349/23, they introduced some more concept to classifying an account as a high risk account. We will not go only by the score the party is getting. We will do some more thing also. For classification of classification of account for high risk is based on the marks in the respective scoring model. Revised guidelines 349/23. Additional parameter to be taken into account while risk rating to classify as high risk. Additional parameter to be taken into account, even though the mark is within not suppose by doing the risk rating, the borrower is getting a mark which he has to be rated as moderate risk. In spite of that, you have to see these parameters. What are they? Account continuously classified in SMA2 in the last 3 months, even though he is getting a mark equivalent to moderate risk. If the account of the borrower appears continuously as in SMA2 in the last 3 months, then you have to classify him. You have to take a decision to classify him as a high risk also. Interest coverage ratio is less than 1% and no fresh infusion of capital proposed by the entity for meeting the deficit. Then also you can classify the borrower high risk even though mark is coming only for moderate risk. Current ratio is less than 1. Wherever the benchmark current ratio norms are applicable, even though the current ratio is less than 1, in this case also, you can classify the borrower as a high risk borrower. Okay, sir, this is the change that has come in 349. It is updated in a recent credit risk management policy also. But this is one point which I want to tell you. Then, in delegation, we need circular. Okay, loan between two branches. Okay, let us see this question. Then we'll go to the question. Delegation of powers. The latest HO surplus 539/24. So some people will be discussing, or some faculties will be talking to you on that. Whether some small change is there. Whether a borrower can avail credit facilities from more than one branch. This question's answers we'll see. Each borrower to avail all the credit facilities from a single branch only, except which loan? Except loans against our deposit to depositors. Except loans against our depositors to depositors. Okay. If customer needs finance from another branch, circulate the CAC of the branch in which the facility is sought to permit the same. For example, there are two circles, let us assume, Trivandrum Circle or Chennai Circle. In Trivandrum Circle, the borrower has availed a facility, loan facility. In Chennai Circle, for some other purpose, he wants to avail another loan facility. In that case, who has to permit the that is loan? So the circulate of the CAC of the branch in which the facilities are. For example, he availed a loan in Trivandrum Circle. He wants to avail a loan a branch in Chennai Circle. Chennai Circle as head COCAC only has to permit the loan. So they are no other than loans against our deposits. It does not mention whether gold loan is excluded or not. Okay, nothing has been so far mentioned, sir. Okay. Whose permission is needed to so this is with regard to a borrower avails a facility is more than one branch. Okay, and if you put in CBS option 1000 or something, it gives the customer ID and what are all the loans he has availed in various branches. Please exercise caution there also. Okay, whose permission is needed to transfer loan accounts of parties from one branch to another within the circle and to a different circle and apportionment of limits. This is a change here. Suppose if the loan has in 257, that change has come. So in one circle, in one branch, he is having a loan. So he wants to transfer the loan or apportionment of limit. So within the same circle to another branch. Or from one circle he is having a loan, he wants to transfer it to a branch in another circle. Who has to permit it? So earlier, in both the cases, before 257/24 was released, in both the cases, GM, CGM, HOCAC only to permit either transfer of a loan from one branch to another branch in the same circle, or from one branch to another branch in another circle, or for apportionment of limit, only CGM, GM, HOCAC has to permit. In 257, they brought out this change, and which is continuing the latest delegation also. So if the loan account to be transferred or apportionment of limit to be done within the circle from one branch to another head, circle head CAC up to his delegated powers can do it. Chennai circle from one branch to another branch in the same circle, circle head CAC has to permit, branches do not have powers. Beyond this, circulate says up to its delegated powers. So if the powers comes and transfer of loans within the circle from one branch to another, up to circulate CAC powers, he will permit. If it is HO power accounts, only HO has to permit. So even though the transfer is within the circle, different branches. So beyond this, that's why I told beyond the powers of the circulate CAC, and also if the loan account to be transferred from one branch to another branch in another circle, whomsoever power it is, in both these cases, CGM, GM, HOCAC only has to permit the transfer of the loan. That is a change, sir. So first they told transfer of loan within the circle, different branches. Transfer of loan within different circles, different branches, CGM, HOCAC only has to permit. In 257, what they modified, transfer of loans within the circle from one branch to another, up to that circle head CAC powers can be permitted by that circle head CAC. Beyond the powers of the circle head CAC, transfer of loans within the same circle, different branches, and also irrespective of the sanctioning powers, transfer of loans from one branch to another branch with different circles, CGM, GM, HOCAC only has to permit. For apportionment limit, already if it is apportioned, it will continue. If fresh apportionment to be taken, this is the guideline to be followed, sir. Okay, let us see the question number. Question number 7. Whose permission is required for transfer of loan accounts between branches in different circles? Okay, irrespective of the sanction, different circles, sir. Okay. Circle head CAC, CGM, GM, HOCS and above authorities, branch head of the transferor branch if the branch is headed by scale 4 and above, branch head of the transferor branch. Answer is CGM, GM, HOCAC and above authorities. Question number 7, answer is B. So here, there is branch head of the transferring branch. So relevant guide. Last year, one circular has come with regard to transfer of deposit. So earlier, for transfer of deposit within the city limits, beyond the city limits, certain amount and all has been fixed. As per the last, when we discuss the deposit policy, that also we'll see. Just highlight to you, if transfer of deposit from one branch to another, irrespective of the distance, irrespective of the amount of the deposit, the branch head of the transferring branch has full powers to transfer the deposit. Okay, that is with regard to deposit. Here for question number 7, the answer is B. So CGM, GM, HOCAC only has the power to transfer the loan accounts to different circles. That I want to say. Then modification in interest rates on deposits. So sorry, not interest rate. The modification in interest rate for loans against deposit. I have forgotten to include the word loans against deposit. So modification interest rate, loans against deposit, HO circular 621, then modified in 624/24, then it is getting updated in the recent delegation also. Loans against domestic term deposit standing in the name of the depositor. The loan is in my name. Sorry, the deposit is in my name. I am coming, asking for a loan. Loans against the deposit standing in the name of the depositor, loans to the depositor. It is not a third-party deposit. I want to mean that. Loans against domestic term deposit, it is domestic term deposit, standing in the name of the depositor, loan to the depositor. Normally, margin is 10%, domestic term deposit. Interest rate. So here there is a change. So far, so before 621 and 624 was issued, the interest rate was 2% above the deposit rate, irrespective of the loan amount or irrespective of the deposit amount. Now the guidelines have come. So interest rate to be charged is 2% above the deposit rate for loan up to inclusive of rupees 2 crores. If the loan amount is up to 2 crores, then you will charge 2% above the deposit rate. If the loan amount is above 2 crores, then you will charge 1% above the deposit rate. So this is the change. So normally we think 2%. When the loan is given to the depositor against his own deposits, then if the loan amount is up to 2 crores, you charge 2% additional interest. If the loan amount is above 2 crores, you charge 1% only additional interest over and above the deposit rate. And then this circular, you go through it, I don't want to explain. Who has the power to reduce the margin? Who has the power to reduce the rate of interest? For loan amount up to 2 crores, loan amount above to 2 crores. For example, I told you for loan amount up to 2 crores, margin is 10% and rate of interest is 2% above the deposit rate. Whether branch is having any power to reduce it, let us see. Branch in charge, 10%, no power. So 2% additional interest here to charge, he has no power. When you come to RO head CAC, he has no power to reduce the margin, but he has the power to reduce the rate of interest to 1% above the deposit rate. When he comes to circle head CAC, he has power to reduce the margin to 5% and he has to reduce the interest rate to 1%. You should not miss out, which is not correct with regard to the following. With regard to loans against deposit to the depositor. So circle head CAC can reduce the margin to 5%. He can reduce the interest rate 1% above the deposit rate. Like that options will be there. So this slide you should know. So from that circular, I have picked up this slide. So CGM-GM-HO-CAC, he can reduce the margin to 5% and he can reduce the rate of interest above the deposit rate to 0.75%. EDCAC, 5% and 0.50 and CAC of the board. So the margin can be reduced maximum by 5% only. If the loan amount is 100 crores, you can give maximum only 95 crores. No authority can reduce the margin below 5% in the bank. So rate of interest, so beyond the delegated power EDC, so EDCAC can really increase the rate of interest. That way, the deposit rate is 10%, EDCAC can fix 10.50 for the loan. If the rate of interest to be further reduced to below 10.50, board CAC has full delegated power. They can fix the rate of interest for the loan equivalent to the deposit rate. Okay, so this is with regard to loan amount up to 2 crores, loan amount above 2 crores, like that I have given. So please go through the slide. So any questions will be asked over that. Okay, now then we'll see. So this is about loans against deposits to the staff members. Okay, I need not deliberate on that. So this is the old circular was 451 by 2018 that continues. And then so loans against deposit to the, we should not say loans against deposit to the employees. We should tell loan against deposit to the depositors who are eligible to get preferential rate of interest. So who are eligible to get preferential rate of interest is given in HO circular 92/24. In deposit policy, we will discuss about it. If the loan amount is up to 1 lakh, 0.25% above the deposit rate. Loan amount is more than 1 lakh up to 5 lakh. This is the rate. More than 10 lakhs if it is a loan amount as applicable to customers. You know, up to 2 crores, 2% above the deposit rate. For loans above 10 lakhs, circular CSE can reduce rate of interest up to 1% above the deposit rate. You know, for normal customer, if the loan against deposit is up to 2 crores, rate of interest is 2% above the deposit rate. For this staff member, he is having a deposit, that is a person is having a deposit who is eligible to get a preferential rate of interest. In that case, for example, I am an ex-employee. So I am eligible to get a preferential rate of interest. So for my deposit, I want a loan of about 10 lakhs. So normally you will charge as applicable to the customer. Circulate CAC can reduce it up to 1% above the deposit rate. Okay, that is it has come in 257 and 539. That is why I brought this and brought this. So for your information also, anybody asks what is the additional rate to be charged to the preferential rate of interest deposit loan, the base circular is 451 by 2018. That has not undergone any change so far. Okay, sir. Now, what is the delegation of power for sanctioning? You know, margin is 10%. Even though the margin is 10%, for example, I'll tell you. So a scale 1 officer is heading a branch. So let us assume I am having a deposit of 1 crore. I am having a deposit of 1 crore. You know, domestic deposit, the margin is 10%. So the maximum loan I can get against the deposit is 90 lakhs. So let's assume I am having the deposit in a branch. The branch is headed by scale 1. I am approaching the scale 1 manager. Sir, I have a deposit of 1 crore. I want 90 lakhs. The margin is 10%, whether the branch give. So even though the margin is 10%, so various authorities are given with the maximum loan only that can be given against the deposit, even though the margin is 10%. So, for example, if the branch is headed by scale 1, so the depositors, that is loan against deposit to depositors, he can give maximum 25 lakhs only. That means the margin is 10%. He cannot give 90 lakhs. It has to be referred to some other authority. Loans to third parties against a deposit, third party loans. Okay, we are not discussing about anything here. It is 5 lakhs only. If it is a minus deposit, scale 1 heading branch in charge can give only, that is 1 lakh. Then if the branch is headed by a scale 2 or credit manager or manager in a VLB, LB, this is the power he is having. Senior managers on BLB on scale 3 heading branches, so 75 that is lakhs and 3 lakhs he is having, like that various delegation of here. Here what I want, because when I interact with people, when I ask them, so I have a 1 crore deposit, you are scale 2, so when I come to you for a loan, how much loan you will give? So immediately people will tell 90 lakhs by keeping the margin of 10%. Yes, even though the margin is there, the scale 2 is having a power only to give 50 lakhs. So since I am eligible for 90 lakhs, the proposal has to go to some other authority only. So that to highlight the point only. So from, even though not from the examination, from your updations, whom many of you may be knowing, whomso do not know it, please get it updated. Then loans against domestic term deposit, or various powers I have given. Then loans against NRE FCNR deposit. So the margin is 25%. So loans against domestic deposit, the margin is 10%. Loans against NRE FCNR deposit, margin is 25%. Who can reduce the margin to 10%? Scale 4 and above can reduce it to 4%. Similarly, powers are given to branch in charges, scale 1 or various authorities. Loans against to deposits, NRE term deposits, NRE or FCNR, what is the maximum power they are giving? It is given in the slide. Okay, sir. Now let's quickly go through. Question number 8. Which is the odd man out? Which is not the odd man out? You see the question. The question was framed last year. Somewhere I have seen. So normally the question will be, which is the odd man out? Here the question is, which is not the odd man out? Which is the odd man out means which is not correct, which is wrong. Which is not the odd man out means which is correct. So which is the odd man out means which is not correct. Which is not the odd man out means which is correct. Okay, all of you know it. So just for English this one. Which is not the odd man out with regard to loans against domestic term deposit to the depositor. So you have to tell which is the correct answer option. 2% above the deposit rate irrespective of the loan amount. Margin 10%. 1% above the deposit rate for loans up to inclusive of 2 crores and 2% above the deposit rate for loans above 2 crores. None of these. So which is correct? Here, point number A is not correct. 2% above the deposit rate irrespective of the loan amount. That is not correct. Margin 10%. That is correct. 1% above the deposit rate for inclusive of 2 crores. No, that is ulta. 2% loans up to 2 crores, 1% for loans above 2 crores. So A is not correct, C is not correct, D is also, A is not correct, C is not correct, D I have given the option none of these, that is also not correct. The correct option is margin 10. So which is not the odd man out. So which is the correct answer is being question is asked. Answer for this question is B. Okay. The value of domestic term fixed deposit is 1 crore. It is VLB and the branch in charge is scale 4. What is the maximum amount of loan senior manager of the VLB can sanction to the depositor against this fixed deposit with a margin of 10%? Friends, all of you know, whenever the branch in charge is available, he only has to sanction the loan. Okay, whenever the branch in charge is available, he only can sanction the loan. But there are two exceptions to that. In respect of branches headed VLB or ELB executed by that is headed by executives, and also in respect of RAHS headed by executives, in the respect of branches which are headed by executives, the credit manager or the senior manager of the VLB or ELB can also sanction some loans even when the branch in charge is present. What are all those loans? Gold loan up to his delegated power. Then BSL against the deposit up to the his delegated power, and Canara pension. So whenever normally as per the guideline, when branch in charge is present, they only have to sanction the loan. But in respect of ELBs, which are headed by the executives, even when the executives are present, the credit manager scale 2 or the senior manager of the VLB or ELB can also sanction the loans which are there. So loans against our loans against our deposits, and then Canara pension and gold loan up to the delegated power of the scale 2 or scale 3. Okay, that only they can sanction. Now let us see. The value of the fixed deposit is 1 crore. It is a VLB and the branch in charge is scale 4. What is the maximum amount of loan senior manager of VLB can sanction to the depositor against this fixed deposit with margin of 10%? 90 lakhs, no, he cannot sanction. 95 lakhs, no, he cannot sanction. 50 lakhs, no, that is 50 lakhs, only branch in charge can sanction, none of these. Question number 9. Your answer should be none of these because he is scale 3. Scale 3, I told you, that is he can sanction loans against deposit to the depositor, domestic deposit, maximum 75 lakhs, even though the margin is 10%. So here, which is valid amount, which is what is the maximum loan amount the senior manager of the VLB can sanction? So 90 lakhs he cannot sanction, even though the margin is 10%. 95 lakhs he cannot sanction. 50 lakhs, that is 50 lakhs also he can sanction if the borrower wants. What is the maximum? Whether the question is the maximum. I put the question, what's the maximum amount he can sanction? So maximum amount he can sanction as per the previous slide is 75 lakhs. Okay, question number 9, answer is, what is the maximum? None of these. Answer for question number 9 is none of these. The correct answer is 75 lakhs. Okay. Then this has come in HO Circular 479/23. This is also by number, you should know. Checking CBS parameters versus sanction. Based on the sanction, the people are preparing the CBS, whatever labs or whatever concept you are telling, where these things are getting updated. Rate of interest. If it is a term loan, it is getting updated in LNM 10, ODOCC in the fast path CHM07. Like the tenor of the loan, margin, moratorium period, sanction limit, primary and collateral security, customer account relationship maintenance. Then you say internal rating, external rating, see where they are getting updated, you see. Then Udyam registered number, legal entity identifier, passport details, sanctioning authority, etc., etc. So this is again the first part. You should know where it has a higher level authorities, where in the sanction these things are getting updated in CBS. So passport details are getting updated in SIM 61. That is why I told. Passport details of borrowers to be updated which past path in CBS? SIM 61. Question number 10, answer is D. Now next question is up to what amount or above what amount you will ask for passport detail of the promoter or guarantor or director, etc., etc. That is as per the credit policy. If the loan amount is above 5 crores, okay, that question comes, you should not miss it. Anyway, they will tell you in the credit policy, if the loan amount is above 5 crores, then passport details of the promoters or passport details of the borrower or guarantor, etc., etc., to be obtained and updated in SIM 61. So if they do not have the passport details, you have to get a declaration from them. Every year you have to review. Every year you have to review and find out whether they got the passport, etc., and get it updated. When you have to obtain the Aadhaar details of the borrowers, the Aadhaar details to be obtained when the loan amount is 5 crores and above. When the loan amount is 5 crores and above, Aadhaar details, passport details to be obtained when the loan amount is above 5 crores. Okay, that is the thing you want to this one. Then we will go to the next slide, sir. Now legal entity identifier. Okay, legal entity identifier. So revised guidelines for obtaining LEI. LEI means legal entity identifier for non-individual borrowers. That means LEI to be obtained not to individual borrowers. If it is only an entity, you know the difference between an individual borrower and entity. In a representative capacity, when a borrower avails a loan, he signs on behalf of a partnership firm, or he signs on behalf of a HUF, or he signs on behalf of a company. These things or he signs on behalf of a trust. This is the representative capacity. We call it an entity. So when the loans are given to entity, we have to obtain LEI. Okay. So the total exposure to a borrower is 5 crores and above, up to inclusive 10 crores. No legal entity identifier to be obtained on or before 30/4/2025. Above 10 crores up, yeah, for all loans above 10 crores, already by this time LEI should have been obtained. So RBI has not told for less than 5 crores when to obtain the LEI. The RBI has told as on date LEI to be obtained for exposure of 5 crores and above. For exposure of 10 crores and above, by this time, all parties should have obtained the LEI. When you have to get the LEI from the party, we will see. So all borrowers with an exposure of 5 crores and above up to 10 crores, LEA to be in place on or before 30/4/2025. So it is not applicable for individual borrowers and departments and agencies of central state government. It is not applicable. For all others, it is applicable. Exposure means not only loan from Canara Bank. Exposure means from loan from all banks and other financial institutions, including investment exposure. So not only credit exposure, not only from Canara Bank, credit exposure from all the banks and financial institutions in the country, including the investment what they have made in other banks and financial institutions. Everything you have to take into account to find out the exposure now. Limit or outstanding balance, whichever is higher, to be considered for arriving at this 5 crores exposure. Okay, the present is above 5 crores up to 10 crores, you have to obtain on or before 34. So this they may ask for scale 1 to 2. What's the cutoff date? 34/25. When it comes for scale 2 to 3, 3 to 4, they may ask for which borrowers. Only individual borrowers and department agencies are exempted. When it comes for 4 to 5 or 5 to 6, they may ask. So investment exposure means what? So whether only exposure from Canara Bank? No, exposure from all the banks. Only credit exposure? No, investment exposure also. So everything we should be able to understand. So what is LEI? It is a new borrower entities not eligible for loan without LEI. It is a 20-digit alphanumeric code. Worldwide financial transaction. Clearing Corporation of India Limited, people can apply and get the LEI number. So 20-digit alphanumeric. For the all new borrowers, about 10 crores, if they want exposure today, they should have LEI. Okay, 5 crores to 10 crores by 30/4/2025, they should get the LEI. So in the case of existing entities, already you are having a borrower. So no renewals, no enhancements, no additional limits, no ad hoc without the LEI depending upon the exposure. As on today, if you want to process a proposal for an existing borrower, anything renewal or something, if the exposure is above 10 crores, what is exposure? I told you, in that case, you have to insist on the LEI. All proposals submitted to the sanctioning authority to incorporate in the first page of the note the LEI with validity date. Sir, the LEI is valid only for 1 year. Like your Form 15G and 15H, LEA is valid only for 1 year. So every year, the LEA has to be got renewed and it has to be obtained from the Clearing Corporation of India. All sanction communication to branches officers to contain the same. That is why if you see here, so LEI in for term loan, you get two options, CAM 17 and CAM 22. Here also, CAM 17 says what is the LEI number. CM 22 says what is the validity of the LEI. So both the things to be updated. That's why I have given here two. Okay, sir, it is valid only for 1 year, like your 15G, 15H. Okay, so this is with regard to this. Okay, question number 10 we have seen. Question number I think next question we'll see, you will get an idea. Identify the odd man out with regard to legal entity identifier. Odd man means which is wrong. Not to be obtained for individual borrowers and department or agencies of central state government. That is correct. It is 20-digit numeric number. That is not correct. 20-digit alphanumeric. So which is the odd man out? Point B is the odd man out. Let's see C. The exposure of is 5 crores and up to 10 crores to be obtained by 30/4/2025. That is correct. Exposure to include all credit and investment exposure from all banks and financial institutions. That is also correct. So for question number 11, which is not correct, point number B is not correct. See, I have seen when the examination for 3 cadres on the same day, examiner takes the question, for example, LEA if he takes, he covers the same question in 2-3 cadres also. So for he will tell 34, 25, very simple for 1 to 2. For 2 to 3, 3 to 4, etc., he may give investment. That is why I covered all the point in the question. Sir, if you are thorough with the subject, you can answer any question. Okay, these questions are only to give you confidence. As I told you, only this one. These are all not the only questions. What are the probable questions from the PowerPoint? You can find out in depth. If you go through the circular, you can answer all the questions. Okay, then we'll go. Okay, this we have seen, LEI we have seen. Now, this is a change in HO Circular 787/2023. So, you know, the project appraisal to be got done by the project appraisal group, project appraisal either in the circle or HO or whatever it is. So now, for the existing borrower, when the project appraisal to be got done, for the new borrower, when the project appraisal to be got done based on the exposure for the new borrower. Earlier, there was one exposure, now the exposure has been revised. For the existing borrower, so when the project appraisal to be got done, it is not only based on the exposure of the party, it is based on the risk rating of the party also. So for the project appraisal, when to be got done, the quantum has been revised for the new borrower as well as for the existing borrower. For the new borrower, the quantum is based, so the project appraisal is based on the quantum of the loan. For the existing borrower, the basis is based on the risk rating and the quantum of the loan also. Both the things are there. That is what I have shown in the slide. That has come in HO Circular 787/23. This is also after your last exam. All medium and long-term proposals for proposed projects, including infrastructure, are eligible for product appraisal. For new borrowers, project appraisal is to be done if the project cost is 10 crores and above. Earlier it was 5 crores. So project appraisal for term loan and medium term loan, including infrastructure project, to be got done by the project appraisal group. If the loan amount is 10 crores and above, earlier it was 5 crores and above, revised in 787 for existing customers. So for existing customer, it is not only the loan quantum, it depends upon how many years he has banked with us, and depends upon the loan quantum and depends upon the risk rating also. 3 parameters are taken for the existing borrower to do the project appraisal. So if the internal rating is low, CNR 1 to CNR 5, and the internal rating is normal risk, that is CNR 6. I told you what is CNR 1, CNR 2, CNR 3. So if you know it, you can answer. You can make it very clear. All of you may be knowing it also. If the internal rating is low means CNR 1 to CNR 5 is called the internal rating low, minimal risk 1, minimal risk 2, low risk 1, etc., etc. So internal rating low risk means CNR 1 to CNR 5. And if the internal rating is normal risk, internal ratings CNR 6 is the normal risk, or if it is an externally rated account, externally rated BBB or better rating, and if the dealings for the party is less than 3 years with our bank, and if the exposure is 15 crores and above, that is project cost. If the project cost is 15 crores and above, earlier it was 10 crores and above. Similarly here, dealing for 3 years and more, less than 3 years, 3 years and more, and the project cost is 20 crores and above, that is, you have to do the project appraisal. So if it is moderate risk, CNR 7 and CNR 8, or external rating BB and that is and better. So sorry, BB or better is here. It is external rating is BB or moderate risk, internal rating. If the project cost 10 crores and above, earlier it was 5 crores and above. Here also it is 10 crores and above. Earlier it was 5 crores and above. So this table, this number you should know. Here only some confusing. Risk rating of the borrower, dealings with us for less than 3 years, dealing with us for more than 3 years. For the new borrowers, only the project cost if it is about 10 crores. Then all project coming to agricultural, that is other than agriculture, and this is for agriculture. Project cost above 4 crores for new customers and above 7.50 crores for existing customers. Agricultural term loans will be appraised by Agricultural Innovation Center. revised from 200 and 500 lakhs respectively. Earlier it was a new customer 200 lakhs, now increased to 400 lakhs. Earlier for the existing customer it was 500 lakhs, increased to 7.50 crore or 750 lakhs. It has to be got done by Agriculture Innovation Center. So this is with regard to project appraisal. In the same circular, one last para has come. Validity period of solvency and capability certificate. So far, before the circular 787, nowhere we have seen the validity period of the solvency and capability certificate. Now, as per HO circular 787/23, which was introduced the first time in the bank, the capability certificate and the solvency certificate, the maximum validity period is 1 year from the date of issuance. So these 2 points are in HO circular 787/23. I thought that is better to discuss with you. So I also shown you question number 12, you see, which is the revised guideline with regard to project appraisal as per HO circular 787/23. For new customers to be done for a project cost of 10 crores and above, and for medium and long-term proposals. For existing borrowers who are dealing with this for less than 3 years, if internal rating is CNR 7 and CNR 8 or external rating BB, to be done if project cost is 10 crores and above. For existing customers who are dealing with more than 3 years and the project cost is 20 crores and above, they are rated externally BB and better, to be done. For existing borrowers who are dealing with us for more than 3 years, if internal CNR 7 and CNR 8 or external rating BB, to be done if project cost 10 crores and above. 5, for new customers, agriculture loans to be got appraised by Agriculture Innovation Center if the project cost is above 750 lakhs and against the 500 lakhs earlier. If you know the table, you can tell immediately which is the correct answer, which is the revised guideline. So these type of options also they are giving. You see here they are not given A, B, C straight away. They are given 1, 2, 3, 4, 5. From that 1, 2, 3, 4, 5, they are chosen the option. You see, A. Our option in the examination is A, 1 and 2 are correct, B, 1, 2 and 3 are correct, C, except 5 all are correct, D, 1 to 5 all are correct. So they are given 1, 2, 3, 4, 5. From 1, 2, 3, 4, 5, they ask you to choose the correct option. Here, D is the correct answer. 1 to 5 all are correct. And please go through it leisurely. Please go through the table. You will understand that is 1 to 5 all are correct. Friends, you can straight away answer the question if you are thorough with the table in 787. More than that, nothing is there in 787. And then capability certificate is also there. Question number 13, you see, with regard to the capability certificate. The validity period of solvency and the capability certificate is 1 year as per HO circular 787/23 from the date of issuance. That also I told you. That also keep in mind. From which date? From the date of issuance, which is not correct with regard to this statement, which is an odd man out. Reduced from 5 years to 1 year, validity reduced from 5 years to 1 year. B, increased from 6 months to 1 year. So far, validity 6 months, increased to 1 year. Reduced from 2 years to 1 year. None of these. The answer for the question is none of these. So far, no validity has been mentioned for your solvency and capability certificate. Now, 1 year is fixed from the date of issuance. So, none of these. So, question number 13, answer is D, none of these. Okay, now, we will go. So PPT, PowerPoint presentation 1 is over. Now we are going to PowerPoint presentation 2. So Journal Appraiser, modified guideline, maybe in the gold loan policy, somebody will be telling. This is a modified guideline, which I thought I can tell you while discussing the credit related matters, because most of the frauds are taking place in the jewel appraisal portfolio. Please exercise caution, ladies and gentlemen. Age increase for the jewel appraiser from 60 years to 65 years, both for branch, RO panel is also there today. So in both the cases, maximum age of the appraiser, earlier it was 60 years, now it is increased to 65 years. That is suppose earlier, because of the 60 years norm, somebody has been terminated, and if they are not yet completed 65 years, you can bring them back to the panel. Who are terminated after the completion of 60 years can be re-empaneled if they are not yet completed 65 years. So the yearly performance appraisal report of journal appraiser as on 31st March. So it has to be appraised. The performance is not only for APAR, for us, for officers, managers, etc. So performance appraisal report for the journal appraiser also as on 31st March. Timeline for submission of the performance appraisal. Branches to RO within 3 days of completion of the March quarter reappraisal of the branch. You see here, It is not within 3 days after March 31st. So branch to RO within 3 days, the performance appraisal report of the Jolla appraiser should be submitted by the branches to the RO within how many days? What is the timeline? Within 3 days after completion of the March quarter reappraisal of the branch. Not from the 3 days from the March quarter, reappraisal of the March quarter only, you are within 3 days. RO to CO, 22nd of every June, it has to be submitted, and CO to HO, that is within 30th of every June, this report has to be submitted. So if they ask it, you should not miss it. I told you, the examiner sees the numbers in the circulars. So accordingly, I have given the cutoff dates also, the period of submission of the performance appraisal. You may miss it out. That's why I have brought it over here. Then, so a Jolla appraiser can be continuously engaged in a branch for 6 years. Suppose that is after 6 years, he can be engaged in another branch. Let's assume you are engaged a Jolla appraiser for 6 years. After 6 years, you cannot engage him back. So he can be engaged by some other branch. Suppose if you want to re-engage him, you have to give a gap of 3 years after your 6 years. See, Jolla appraiser can be engaged continuously for 6 years in a branch, can be engaged in another branch for after 6 years. For engaging a Jolla appraiser in the same branch after 6 years, there should be a gap of 3 years. That means first he was with you for 6 years, he went to another branch. That branch can continuously engage him for 6 years. No, after 3 years going to other branch, he says he want to come back to this branch for various reasons. Then that is permitted. So that is a condition with regard to appointment of Jolla appraisers. Then security deposit also, there is a revised guideline. So security deposit depend upon the gold loan exposure of the branch. Depending upon the exposure of the gold loan exposure of the branch, the security deposit also, the minimum is 15,000 rupees for the exposure up to 2.50. Exposure is for the branch. And then if the exposure of the branch under the gold loan is above 75 lakhs, the security of deposit of the gold loan appraiser is 3 lakhs. For RO panel, whatever it is, because it is not linked to the GL exposure of the branch, the maximum deposit he has to maintain is 25,000 rupees. Okay, sir. Let us see the question. Any question is there? We will see. So we'll be able to answer the question. Okay. So question number 14, which is not correct. See, in the examination I have seen, or you also would have seen, wherever there is a negative question is asked, they put there not. Or odd man, they put in that is bold and capital letters. So that is why I have put here, which is not correct with regard to Jolla appraiser as per HO Circular 71/24, which is not in that circular. Maximum age is 65 years. That is correct. Jolla appraiser can be continuously engaged in a branch for 6 years. That is correct. He can be re-engaged in the same branch after 6 years. No, he can be re-engaged in the same branch after 3 years. So security deposit Jolla appraiser RO up to 25,000. So which is not correct? Option is C. So for question number 14, answer is C. Okay. Now another important guidelines has come in the bank with regard to periodical obtention of encumbrance certificate. So when we have to obtain the EC, so far, before the first point, it has come in the circular 98/24. Subsequently, it has updated in your credit policy. 255/24 is also your credit policy in the year. It has come in the month of April. Then up to June 2024, 516/2024. First obtention of periodical encumbrance certificate has come in 98/2024. When EC has to be obtained, it is not only at the time before sanctioning the loan and subsequently for the broken period EC. What is a broken period EC? Before sanctioning the loan, you will get a EC by the panel advocate, he will scrutinize it. So once the loan is sanctioned or disbursed, so from the date of the EC, then till the date of disbursement, you have to get a broken EC. That EC is called a broken period EC. Besides these two things, we have to get periodical EC also as per HO Circular 98/24 when it has to be obtained. All accounts including NPA where immovable properties are mortgaged to the bank. So including NPA accounts, periodical EC to be obtained. So, which is the only exempted account? The only exempted account is accounts which are eligible for legal audit. It is not applicable. So, what is legal audit? So, you have a post-legal audit, no, after the loan is disbursed or sanctioned, etc., etc. If the exposure is 5 crores and above, these things will be discussed in the credit review and monitoring policy number 64 by 2024. So, with the exposure to a party is 5 crores and above, then a legal audit to be conducted during the period of RBIA, that is risk-based internal audit, which is nothing but your regular branch inspection. So if the exposure to a party is 5 crores and above, post-legal audit will be conducted after a loan is disbursed, etc. What the inspectors will see, they will visit the property, they will get an LSR from another panel valuer who has another panel advocate who has not given the earlier LSR. They will get a EC and they will check up everything is pakka in that mortgage property. So the accounts which are once the above exposure loans is given, you do the legal audit. Then once in 3 years, along with RBIA, the legal audit will be conducted. So the accounts which are eligible for legal audit, you need not get periodical encumbrance certificate. That means when you will get the periodical encumbrance certificate for legal audit, exposure is 5 crores and above. In all other cases, less than 5 crores where the account is not subject to legal audit, you need not get periodical encumbrance certificate. So periodical encumbrance certificate to be obtained for all the loan accounts, including NPA accounts where immovable properties are mortgaged to the bank. This is the only exemption. For existing accounts to be completed within 90 days from 17 to 2024, 17 to 2024 is the date of the circular, 98/24. To be obtained within 36 months from the date of creation of the mortgage and subsequently every 36 months. This is in addition to obtention of broken period EC immediately after putting through the EMT. I told you what is a broken period EMT. So equitable mortgage transaction. Charges are to be borne by the borrower. So for getting periodical encumbrance certificate, the charges are to be borne by the borrower. So maximum fee payable by the bank to any agent who is getting the EC from the sub-registrar office or through online, whatever it is rupees 500 per mortgage property. So that is the maximum amount you can debit to the customer's account besides any charges charged by the government authorities. So this is a new guideline with regard to obtention of the encumbrance certificate. Let us see the question. Any question is there? Question number 15, which is not the present guideline with regard to obtention of encumbrance certificate where immovable properties are mortgaged to the bank as per HO Circular 516/24. I told you 98/2024. Then it is reproduced in your credit policy also 516/2024. So I have given up to the latest circular number. You need not go and see 98/24. You can see 516/24. To be obtained within 36 months from the date of mortgage and subsequently every 36 months. Correct. Charges to be borne by the borrower. Correct. Maximum charge payable to any agent or advocate is 500 per mortgage property besides the actual charges payable to the government. Correct. Applicable to all accounts other than NPA accounts. Applicable to all the accounts other than NPA accounts. D, E, none of these. See, I told you it is applicable to all the accounts, including NPA, wherever immovable of property is taken, excluding the accounts which are subject to legal audit. So, option D, you see, applicable to all the accounts other than NPA accounts. That is wrong. Applicable to all the accounts, including NPA accounts. Okay, including NPA accounts, applicable to all the accounts, including NPA accounts, excluding the accounts subject to legal audit. So point number D is wrong. Question number 15, your option should be D, which is not correct. Okay, sir. Then we'll see the next presentation, which is the recent change. Release of loan documents. So whenever the borrower is closing the loan, so the mortgage property, the property documents, and the charges created in the SERSOI or charges created for MODDT, wherever it is applicable, etc. So branches have to release them, clear the charges, and hand over all the original title deeds or original documents as per LSR. So at the time of LSR, so the panel advocate would given which are all the documents deposited by the borrower. which are all original, which are all copies. So, and where bank has created the charge. So, after the loan is closed, the bank is supposed to return the original documents as per the LSR after clearing all the charges in the registries. Now, what is the guideline? So that first guideline has come in 849/23, then reproduced 99/24, then 255, and the latest credit policy 516 also it finds a place. This is with effect from 1/12/2020. Sometimes they'll ask the date. So this is with effect from which date? Sometimes they ask RTGS has been made 24/7. This is with effect from which date? So you should also know the date. That is why I put with effect from 1/12/2023. Okay, sir. To release all original documents and remove charges, if any, registered with any registry within 30 days after full payment. If untraceable, if the documents are not traceable, bank to make all arrangements to get duplicate document within 60 days of closure of loan. Cost to be borne by the bank. For delay in release of documents and releasing the charges with the registry within either 30 days or within 60 days, because when the duplicate documents are required, your bank is done in 60 days. If both the things are not done, customer has to be compensated at the rate of rupees 5,000 rupees per day. Okay, if the customer claims, so bank has to compensate to the customer, and that means so when the loan is closed, please ensure that SETSI, MODDT, everything is cleared within 30 days, and the documents are taken out, and you have to hand it over to the customer within 30 days of closure of the loan. Immediately on the date of closure, you are not able to close, then you have to ask the customer and come on a particular day, and you have to give. That should be within 30 days. So what are all the original documents in the LSR it is mentioned, all those things you have to give back to the customer. If the borrower fails to collect, suppose, so 30 days, you keep everything ready, but borrower is not coming. Whether you have to charge the borrower, yes, you have to charge the borrower. If the borrower fails to collect within 30, you are keeping everything ready. You are asking the borrower also telephoning, sending an email, but that fellow is not coming. But that will never take place in the banking industry. If the borrower fails to collect within 30 days, safekeeping charges of rupees 500 per month to be collected from the borrower. For gold loan, the safekeeping charges is rupees 200 per month. Okay, these numbers you should know. The above guidelines are applicable for all loans. Okay, the above guidelines, whether in loans given to individuals or loan given to entities, the timeline is 30 days and timeline is 60 days. Okay, if the loan documents are lost, it is 60 days or within 30 days. The timeline is applicable. But the penalty, the payment of penalty is applicable only to the loans availed by the individual borrowers. Okay, so but compensation payable is applicable only for personal loans. The compensation 5,000 rupees need not be paid for loans availed by entities if the documents are not released within third. But you have to release. But if you are not releasing due to some reason, the compensation you need not pay. But the individual personal loan borrowers, the compensation to be paid. So there is an SAS package in the bank, a document release tracking system, DRT. If they ask you, maybe for 1 to 2, they may ask expand DRTS, document release tracking system. As per HO Circular 883/23, the moment this loan is closed, any documents related to the loan to be handed over to the borrower, that has to be updated in the SAS package under DRTS. So every time that package, if you take a printout, it will give what are all the loan accounts are closed, when it is closed, whether the documents, why the documents are not yet released, it will give a list. For parting with the loan documents in the case of deceased borrowers, for example, borrower has died, the loan is closed. You have to release the document to the legal heir. If it is a joint borrower, you have to release the document to the joint borrower along with the legal heir of the deceased borrower. Then what is the guideline? So whenever a loan is closed, irrespective of the sanctioning authority, the branch in charge has the power to release the document within 30 days or 60 days. You need not go and ask for permission from some other authority. Only in the case of a staff of housing loan, releasing the property, the sanctioning authority's permission is required. The present sanctioning authority for employees housing loan is RO head. It is not RO head CAC, RO head, individual authority. Only when the staff housing loan and all is sanctioned, close, releasing the documents you have to permit as on date from the sanctioning authority of the employees housing loan. In all other loans, when the loans are closed, irrespective of the sanctioning authority, branches are having the power to release the document. But the branches are having the power to release the document. But if the borrower has died, you want to release the document to the legal head. Or if the borrower has died, another borrower is there, joint borrower. You have to release the document to the joint borrower. You should not release only to the joint borrower. You have to release the joint borrower along with the legal heirs of the deceased borrower. In these two cases, that is, or irrespective of the sanctioning authority, branches cannot release the document. Permission from RO head is required. Permission from RO head is required. Branches are requested to refer the manual on documentation, parting with the title days. Your documentation manual is updated till 30/4/2024, if I am correct. Please refer your internal guidelines. So parting with the title deeds to refer manual on documentation and death claim manual. So based on this, you get RO get permission and release the document. In these cases only, you have to get RO head's permission. On closure of the loan, intimate the borrower to collect the document. So you have to send immediately. Borrower has closed the loan. You are telling someone collect later. After closing the loan, you have to say the borrower has not collected on the same day. You have to send an intimation to the borrower to collect the loan and wait for his response. If he has not collected even after 15 days is over, you have to send a second reminder after 25 days to send a second reminder. The format of the letter is available at your circular 849/23. So maximum charges payable to the panel advocate to arrange for duplicate document is 3,000 rupees per document. So from this circular, the probable question is within how many days it has to be released? 30 days. The document is lost within how many days? Then what is the penalty you have to pay? The penalty is only for individual personal loans and not for entities. And then what's the maximum charge you can pay to panel advocate to collect the duplicate charges? The charges to be borne by the bank. And then if the borrower does not turn up within 30 days, what is the charges you have to collect per month from the borrower for gold loan other than gold loan? And then if the borrower died, whose permission is required to release the title documents, and what is DRTF? Okay, so what is the number of days within remainder to be sent? 15 days, 25 days. So from those two circulars, the crux of the circular I have made in this presentation. Okay, sir. If you have time, you can go through the circular also. So probable questions are expected over there. Question number 16, which is not correct. Question number 16. Which is not correct with regard to release of loan documents as per HO Circular 99/24, reproduced in HO Circular 516/24. 516 is the latest credit policy, sir. 99 is the first circular. The guidelines have come. To be released within 30 days of closure of the loan account by clearing all charges registered with the registry. Okay, B. If the documents are not traceable, bank to make arrangement to get duplicate documents within 60 days of closure of the loan account. That is also correct. If borrower fails to collect within 30 days, safekeeping charge ₹500 for gold loan 200 per month to be collected. Yes. Immediately on closure of the loan, if the borrower does not collect the document within 15 days of closure of first reminder to be sent, and if not collected within 25 days, second reminder to be sent, none of these. So which is not correct? None of these are not correct. That means all are correct. Okay, so none of them are not correct. That means all of them are correct. So for question number 16, point A to D are in the circular. So none of these is your answer. Question number 16, answer is D. Question number 16, answer is D. Okay, sir. Then we will go to the next slide. So this slide again is some importance over there because the risk weight has undergone a change. So risk weight for various exposures undergone a change with effect from 16/11/2023. At that time, you would have seen a circular where the interest rate for Canara budget loans have been increased because Reserve Bank of India has at the time of discussion with all the chiefs of the nationalized banks, Reserve Bank of India has felt the clean exposure of the bank is increasing at a higher rate. For example, Canara Budget or Canara Pension, all that is unsecured loans portfolio. So personal loans are increasing at a higher rate in the banks. So they want to reduce the that is exposure to these places, because accounts may slip to NPA at a later date. So because of that, the Reserve Bank of India has increased the risk weight for some of the personal loans and also loans sanctioned to NBFC. NBFC means the non-banking financial companies. The Reserve Bank of India has increased the risk weight. Before that, what do you mean by risk weight, sir? So you should know. Then you'll understand the concepts very well. What is risk weight? You know, the minimum capital adequacy requirement, that is capital to risk weighted asset ratio. Capital adequacy ratio means capital to risk weighted asset ratio, CRAR. So the minimum CRAR banks in India is to maintain 9% on the risk weighted exposure, other than capital conservation buffer. Additional capital conservation buffer is 2.5%. You leave it. So the minimum capital to risk-weighted asset ratio, that is the minimum capital adequacy ratio, banks have to keep on the risk-weighted exposure in India is 9%, whereas the Basel norm, and international banks have to keep as per Basel norm only 8%. But Reserve Bank of India has told banks operating in India should keep 9%. Okay, that is different. Now, what is the risk weight? I'll give an example. Let us assume the risk weight is given by Reserve Bank of India. Risk weight is given by Reserve Bank of India. Let us assume the risk weight for gold loan is 100%. Let us assume the risk weight for gold loan portfolio is 100%. Let us assume Canara Bank's gold loan sanctioned by Canara Bank outstanding as at the end of March, 31st March, let us assume is 1,000 crores gold loan. What is the risk weight? I told you 100 crores. So asset is 1,000 crores, that is gold loan. Risk weight is 100%. Now, risk weighted asset, what is third column? So asset is 1,000 crores gold loan. Risk weight given by Reserve Bank of India for gold loan is 100%. Third column is risk weighted asset. What is risk weighted asset? Asset multiplied by the risk weight. So asset is 1,000 crores. Risk weight is 100%. So 100% is to 1,000 crores. Risk weighted asset is also 1,000 crores. Like that, for each portfolio, you have to calculate the risk weighted asset. For example, let's assume for staff loan. For staff loan, if the risk weight is 75%, if you are given total staff loan portfolio of Canara Bank is 100 crores, let us assume, 75 asset is 100 crores, risk weight is 75%, risk weighted asset is 75 crores, 100 into 75. So asset is 100, but risk weight is only 75. So risk weighted asset is 75. So for gold loan, risk weighted asset, you found out whatever is the asset, that is the risk weighted asset. For staff loan, that is what is the asset is 100, whereas risk-weighted asset is only 75. Commercial real estate CRE exposure. For commercial real estate exposure, risk weight is there. Like that, for every segment, you have to calculate the risk-weighted asset. So you total the risk weight. You please total all the risk weight asset of Canara Bank, total portfolio. On that, you have to keep 9% capital. That is called capital to risk weighted asset ratio. So you need not keep capital on the asset. You have to keep capital on the risk weighted asset ratio. If the risk weight is more, you have to keep more capital. If the risk weight is less, it is sufficient if we keep lesser risk weight. I told you staff loan an example, no? Like that. Let us see now. Now you got an idea of risk weight. Risk weight is nothing but you just keep in mind it's a capital bank has to keep. More the risk weight, more risk for the loan, and more risk, capital the bank has to keep. That is the idea, sir. Okay. With effect from 16/11/2023, risk weight of certain categories have undergone a change. That has come in. It was the first 852/2023. Then it is updated in a recent policy, credit risk management policy 520/24 also. So with effect from 16/11/2023. For consumer credit exposure, including personal loans, but excluding housing loan, education loan, vehicle loan, and gold loan, increased from 100% to 125%. So, consumer credit exposure other than housing loan, so for example, Canara Budget. Okay, like that, various consumer credit Canara pension. So consumer credit exposure, including personal loan, but excluding housing loan is also a consumer credit. Education loan also given to an individual. Vehicle loans also given. GL also given. For all other than these four, it is increased from 100% to 125%. That is risk weight for. That is why interest rate on your Canara budget loan increased during that period, because bank wants to reduce the exposure on those categories. Because if you increase, earlier it was only 100%, now 125%. Earlier you had to keep capital only 100, now you have to keep capital 125. That is why the interest rates have gone up. Okay, now for credit card receivable, outstanding under credit card receivable, earlier it was 125%, now it is 150%. So risk weight for personal loans other than these loans increased from 100% to 125%. Canara credit card receivable is also a personal exposure, but here the risk weight increase. Earlier it was 125 because risk is more. So 125%, it is increased to 150%. So here, so this is very simple. So 100 to 125, 125, 150. One small, you have to apply a little mind, you will understand it. It's not at all a problem. You're all learned people. I need not tell you. Bank credit to non-banking financial companies, excluding core investment companies. What is the risk weight for NBFCs, loans given to non-banking financial company? Non-banking financial companies are divided into non-banking financial company and core investment companies. Let us not worry about the definition. For risk weight for NBFCs under core investment companies is 100%. Okay, no, there is no change. Risk weight for NBFCs under core investment companies, it is 100%. So for other NBFCs, what is the risk weight? So far, there was one risk weight. Now the risk weight has increased. What do you mean by risk weight? The capital you have to keep. Okay, existing guideline. I'm telling about existing. So for excluding core investment company, it is 100%. Existing guidelines. The risk weight is as per the risk rating given by external credit assessment institution. So risk weight is as per. So if the rate NBFC is rated AAA, for AAA companies, what is the risk weight? That we'll see in the next slide. For AAA rated companies, what is the risk weight? It is there. So far, if a company is risk rated as per ECAI, NBFC company, so the risk weight is as related to the risk rating given by the risk rating agency. Now, what is the revised guideline with effect from 16/11/2023? Revised guidelines. If the risk weight to be assigned is less than 100%, it will be 25% more. For example, if an NBFC is rated AAA, then normally the any external agency rated an institution as AAA, the risk weight for that institution is only 20%. For example, let's assume you are given a loan to a company. 100 crores is a exposure. The risk rating by the external rating agency is AAA. If the AAA rating is there, the risk weight is only 20%. How much loan you are given? 100 crores. How much risk weight is only 20%. So what is the risk weighted asset? Only 20 crores. Even though you are given 100 crores exposure, since the company is rated AAA rated companies 20% is the risk weight. So it is sufficient if we keep capital for 20 crores instead of 100 crores. Okay, that is why we go for that is when the risk rating is AAA, AA, etc. We'll give more loans, but those companies will demand many things from you. They want rate of interest or subprime rate. They want rate of interest sub RLLR, etc. So they also demand many things from you because they are all risk rated very well by the external credit assessment institution. So far, if the risk rating for NBFC is as per the risk rate, that is risk weight for the NBFC is as per the risk weight assigned by the risk rating agency. Suppose if the risk weight assigned by the risk rating agency is one, let's assume risk weight is AAA or A. If the risk weight for that is less than 100%, now the risk weight you have to keep that is 25% more than that risk weight given as per the risk rating. I'll show an example. For example, you see, I'll come there. I'll come there. If I explain this, you'll understand it. See, first we'll see. See. So, if a company is rated, any company is rated as AAA, the risk weight is 20%. If any company is rated AA, the risk weight is 30%. If a company is rated A, the risk weight is 50%. And the company is rated BBB, an entity is rated BBB, the risk weight is 150, BB and below 150, unrated is 100. Suppose if an NBFC, priority and other, they are classified from 1611. If the NBFC's loan is given for priority sector, the risk weight is the same. On the other hand, if the loan is given by the bank to an NBFC which is other than priority, but by AAA, you have to normally risk weight is only 20%. Now, originally it is 20%. Now, the risk weight you should have to take 25% more than the 20% given. That is 20% plus 25. That means the risk weight should be 45%. This is applicable for what? Up to less than 100% risk weight. Here it is 20, you should make it 45. Here it is 30, you make it 55. Here it is 50, you make it 75. Here it is 100, you need not make 125. Here 150, you need not make 175, etc., etc. If the risk rating given by the external credit assessment institutions, you have to find out. Then for risk rating, for that risk rating, what is the risk weight assigned? You have to see normal risk weight. If the NBFC is other than a priority sector, other than a core investment company, then if for the risk weight less than 100%, you have to add 25% more risk weight. That is a revised guideline with effect from 16/11/2023. So core investment companies, it continues to be 100%. So this is the only change. Okay, here I will see. I'll go back to you. So this housing loan limit. So risk weight for others. So we have seen risk weight for individuals, and we have change in the risk rating for individual personal loans, and we have seen the change in the risk rating for NBFC other than priority. Now coming to, so all other sectors, bank is not giving loan only to personal, or bank is not giving only loan to NBFC. So now loans for other sector are also there. So what is the risk weight for that? In that there is no changes. So 16/11/2023, only two changes have come. In personal loan sector, certain risk weight has increased, including credit card receivable. NBFC other than priority sector, risk weight has increased. That is why after in December 23, your balance sheet, or March 24 balance sheet, if you see Canara Bank's balance sheet, the NBFC loans you are given, you have, that is pre-closed, they have pre-closed the loan because risk weight increased by RBI, you charge more interest to them. They pre-closed that. That is NBFC loans. If you see the balance sheet, you will get an idea. People who are in the scale 4 to 5, 5 to 6, when they go for the interview, they may ask, why NBFC portfolio suddenly has come down in the bank? Because, so the risk weight increased. When the risk weight is increased, so you want to charge more interest to them. When they want to charge more interest, they pre-close the loans. Okay, good. Okay, then commercial real estate sector, the risk weight is 100%. That is, if you give loan 100 rupees, capital you have to keep for 100 rupees. Commercial related residential housing. What do you mean by CRE residential housing? It is not third house, fourth house, etc. Commercial related residential housing means you are giving loan to a builder who construct flats, and he is going to sell the flat to others. That is called commercial real estate residential housing. Loans given for commercial real estate residential housing, the risk weight is 75%. That means 100 crores loan you are given, it is sufficient if you keep capital for 75 crores. You need not keep 100 crores. How much capital you have to keep? 9%. Okay. Capital market exposure. What is capital market exposure? So bank has invested in various, that is companies, various shares, etc. So bank has invested, or bank has given loans against shares, debentures, and bonds, isn't it? So there are two types of capital market exposure. What is two types of capital market exposure? Banks loans against shares, share brokers, etc. is called one type of capital market exposure. That is called indirect capital market exposure. When bank has invested in that capital market, bank has subscribed to shares, etc. Bank also can do investments. That is called direct capital market exposure. One question they are always asking: what is the maximum capital market direct? What is the maximum total capital market exposure for a bank in a financial year? For example, we are in the financial year 2024-25. The maximum exposure of a bank to a capital market exposure should not be more than 40% of its net worth as on 31st March of previous year. For the year 24-25, 31st March 2024, what is the net worth of Canara Bank? On the net worth of Canara Bank, the total capital market exposure should not exceed 40%. You should not forget if they ask that question. Suppose I told you two types of capital market exposure: direct capital market exposure and then total. So the total is 40%. If it is direct capital market exposure, it should not exceed 20% of its net worth. That is, bank's direct investment should not exceed 20% of its net worth. Both put together, it should not exceed 40% of the net worth as on 31st March of the previous year. So capital market exposure, the capital market exposure risk is more. So the risk weight is more than 125%. Venture capital. So venture capital, new ventures are started. Bank is exposing to those units for loans. So here also the risk is more. So the risk weight is 150%. Consumer credit, personal loans, I told you 125%. From 100% to 125%, it is increased, other than housing loan, vehicle loan, education, and gold loan. Earlier it was 100%. Vehicle loan 100% continues to be. Gold loan also is now 125% risk weight. Credit card receivables. So 150 against 125, revised with from 16/11/2023. Then education loan, it is 75%. And regulatory retail, exposure for regulatory retail is 75%. What do you mean by regulatory retail? Regulatory retail includes individual segment loans and loans to small business. Small business turnover up to rupees 50 crores and the exposure is up to 7.50 crores. It is called regulatory retail with effect from 12/10/2020. Before that, the regulatory retail means the exposure was up to 5 crores. Now it is increased to 7.50 crores. This is the risk fight for regulatory retail, 75%. Then let us see. Then, as I told you, so there is risk rating. Risk rating by external credit institutions, I told you, above 25 crores, you got done the risk rating. So the risk rating is done, that is short-term claims on long-term claims. That is claims. What do you mean by long-term claims on short-term claims? Maybe for a higher level. So long-term claims means loans repayable after 1 year, including ODOCC. Loans repayable after 1 year, including ODOCC, are called long-term claims. So whenever a risk rating is given for a loan given to that is corporate, sorry, the long-term claims, if the risk weight is given by the risk rating agency is this much, so AAA 20%, AA 30, A 50, B, etc. This is a risk weight to be maintained by the bank. Here only I told you, if it is NBFC other than priority, then additional 25% you have to keep up to, that is 100% risk weight. I already explained to you. Now, what is a short-term claim? Short-term claim, loans which are repayable within 1 year, so excluding ODOCC. There they will not give the rating AAA, A, etc. For short-term claims, the external credit assessment institutions will give the rating A1 plus, A1, A2, etc. Here, the risk weight is like this only. More or less, the risk weight is the same, but the rating is, the nomenclature of the rating is different. So this is the risk weight for long-term claims and this is a risk weight for short-term claims, externally credit rated institutions. So now earlier rated, I told you, as per HO Circular 477/2024, if the earlier rated account has become unrated, 1% additional interest you have to charge. 477/2024. Keep in mind. So here also, if the account is earlier rated, now it is unrated, and if the exposure is more than 100 crores, earlier rated, due to some reason it was not rated. Now earlier, let's assume it is rated, and it has given a rating A. So 50% risk weight you have kept. Now the rating period is over. Now it is not rated. And if the exposure is more than 100 crores, now you have to keep a risk weight of 150%. Keep that in mind. All unrated corporate, so that is, this is a risk weight. For unrated, it is 100. Earlier rated, now unrated. If the exposure is more than 100 crores, that is, it is 150% risk weight. And then all unrated corporate having all unrated corporate having aggregate exposure of more than Indian rupees 200 crores from the banking system will attract a risk weight of 150%. So unrated is 100. All unrated corp, normally it is 100. If the exposure is more than 200 crores from the banking system, the unrated will not attract 100% risk weight. They will attract 150% risk weight. Okay, sir? So this NBFC I explained to you, red I told you before 16/11/2023. They may ask the date. From which date the risk weight undergone a change? What was the earlier? Now what is that one? That is why I given different. And only two things underwent a change. NBFC's priority less than 100% risk weight, 25% more you have to give, even though the rating is the same. So, and in the case of individual certain loans, your risk rating has increased after 16/11/2023. That is given in which HO circular I also. So short-term claims, long-term claims. That is more or less A1, A like that will be mentioned. There also short-term claim NBFC less than 100, you have to give 25% more. Okay, staff loan. So what is the risk weight for staff loan? For staff loan also risk weight is there. If the staff loan is fully covered by superannuation benefits, so retirement benefit of the employee, you are going to get, and collateral, or if you are given a housing loan or given Canara, that is Canara mortgage, you can give Canara mortgage also to a staff member. So collateral of residential property, 20% is the risk weight for the loan. Even though the loan is 100 crores, 20 crores only you will keep 9% capital. For all other staff loan, it is 75% is the risk weight. Then claims on domestic sovereign, that is loans given to central state governments, domestic sovereign. So loans within India, loans given to central state government, and then second is loans guaranteed by central state government. What is the risk weight you have to keep for these loans exposure? So direct claim, direct loan is given to central government or direct loans guaranteed by central government, the risk weight is only 0%. Direct credit exposure to state government, investment in state government securities. If you are giving a loan to a state government or if you are investing in state government securities, it is only risk weight is only 0%. So if you are giving a loan against the state government guarantee, so loans given to central government, loans against central government guarantee, 0% risk weight. Loans given to state government, 0% risk weight. Loans given to individual, loans given against the guarantee of the state government, risk weight is 20%. Here you see loans against the guarantee of the central government, no risk weight. Loans given against the guarantee of the state government, risk weight is 20%. Claims on Reserve Bank of India, that is loans given DACGC, CGTMSC, CGFMU, etc. 0% is the risk weight. Claims on ECGC, so there you have a risk weight of 20%. Exposures to covered under CGCMC, you have still a risk weight of 20%. So this is with regard to claims on domestic sovereign. Claims on foreign sovereign. I told you foreign claims, various credit rating agencies will do the risk rating. So this is given by the international risk rating agencies. SP and India ratings, if they give the rating AAA to A, and Moody's rating AAA to AA, and this is a risk weight you have to keep. So these are all the numbers you should know. The idea is anything asked under risk, because the risk weight undergone a change now from 16/11. When the risk weight undergone a change, there is a possibility they may ask questions in the existing guideline also. Anything in detail, people who are taking the credit policy, they will tell you. And one important thing before that, in the risk rating. So this is all these loans that based on the total quantum, the risk weight is determined. Now, we forget this. Now for housing loans given to individuals, what is the risk weight bank has to keep with effect from 1/4/2023? So let us take the latest. Previous things are also there. Let us forget it. For housing loans given to individuals with effect from 1/4/2023, you cannot say risk weight is 125%. You cannot say risk weight is 100%. The risk weight depends upon for housing loans sanctioned to individual on or after 1/4/2023. The risk weight depends upon the loan quantum and the LTV ratio also. What is that LTV ratio? Loan to value ratio. So the risk weight depends upon, you see different risk weight given. It depends upon the loan quantum and the LTV ratio also. So if the loan amount is up to 30 lakhs and if the LTV ratio is less than or equal to 80%, the risk weight is 35%. What is that LTV ratio? LTV ratio means loans to value. What is my LTV ratio? Loans to value. Loan amount or liability divided by the security value is called loan to value ratio. Now you tell me, I give the formula for LTV ratio. Loans divided by the value of the security. Whether if the LTV ratio is more, if it is good for the bank. If the LTV ratio is less, it is good for the bank. So what is LTV ratio? Loan or liability divided by the security value. So if the LTV ratio is more, it is good for the bank. Or if the LTV ratio less, it is good for the bank. So LTV ratio means loan to value ratio. So LTV ratio, so loan amount divided by the security value. When the LTV ratio will be less, LTV ratio will be less when the security value is more, isn't it? When the LTV ratio will be less, the LTV ratio will be less when the security value is more. When the security value is more, LTV ratio is less, the risk weight is less. Again, I repeat, when the security value is more, because the formula is loan or liability divided by the security value. When the security value is more, LTV ratio will be less. When the LTV ratio is less risk for the bank, so hence less risk weight. That means less capital for that portfolio. You keep that in mind, you'll get an idea. So I'll tell you. Individual housing loan sanctioned on or 1/4/2023. What is the risk weight? The risk weight given to those loans depends upon loan quantum as well as LTV ratio. It does not depend upon only the loan quantum like other exposures. So if the loan quantum is up to 30 lakhs and if the LTV ratio is less than or equal to 80%, the risk weight is only 35%. I told you, lesser the risk weight, lesser the LTV ratio, lesser the risk and lesser the risk weight. So if the loan amount is up to 30 lakhs, loans given to individuals housing loans, up to 30 lakhs, if the LTV ratio is less than or equal to 80%, risk weight is only 35%. If the loan amount is, yes, again, if the loan amount is up to 30 lakhs, if the LTV ratio is more than 80% but less than or equal to 90%. So more than 80%, less than or equal to 90%, the risk weight you see, more LTV ratio, risk weight is also more. And other category is only one risk weight. If the loan amount is about 30 lakhs up to 75 lakhs, and if the LTV ratio is less than or equal to 80%, so your risk weight is 35%. If the loan amount is above 75 lakhs, LTV ratio equal or less than 75%, risk weight is 50%. Here, I want to bring one more concept, the margin also. So when the LTV ratio is less than or equal to 80%, the balance amount is the margin by the promoter. For example, if the LTV ratio is 80%, that means if the LTV ratio 80%, the margin by the promoter is 20%. If the LTV ratio is less than or equal to 80%, so risk weight is 35%. If the LTV ratio is more than 80%, let us assume the LTV ratio 85%. If the LTV ratio 85%, the margin is 15%. So the maximum LTV ratio, you can go only up to 90. That means the minimum margin for housing loan up to 30 lakhs should be minimum 10%. It cannot be less than 10%. Here it will be more than 10% margin. Here it can go up to maximum of 10% margin he has to necessarily minimum he has to bring. LTV ratio cannot be more than 90% for loans up to 30 lakhs. Similarly, for loans above 30 lakhs up to 75 lakhs, the LTV ratio should be equal to or less than 80%. That means the minimum margin should be 20%. It can be more than 20%. So when the LTV ratio comes down, the margin will go up. So for loans above 75 lakhs, the LTV ratio should be necessarily be less than or equal to 75. That is, the margin should be minimum 25%. So any question will be asked, sir. They have been asking. That's why I told you. So bank has fixed the margin like that. New house or flat or old house flat up to 10 years old, up to 30 lakhs, margin 10%. I told you, no, up to 30 lakhs, you can minimum margin, you can bring down to 10%. Okay, so here you have made it 20% and they have made it 25% minimum margin. So for old house also they have kept the margin. Okay, now let's see the question, sir. So let us see the question. Question number 17. So question number 17, which one does not match with regard to revised risk weight for credit exposure as per HO Circular 852/2023 with effect from 16/11/2023? Credit card receivables increased from 125% to 150%. Correct. So, friends, please note the date 16/11/2023. If they ask, you should not miss it. Okay, that's why I given. Very specifically, I given here, you see. Credit card receivables increased from 125% to 150%. In the exam, they ask you, why Canara budget interest rates have been increased after 16/11/2023, or NBFC's portfolio has come down because of the increase in the risk weight only. Okay, consumer credit personal loans other than housing loan, vehicle, EL and gold loan, 125% as against 100% earlier. Correct. Bank credit to NBFCs other than core investment companies. For core investment companies, always 100%, irrespective of the risk rating. So, other than core investment companies, if risk weight to be assigned based on the risk rating of ECAI is less than 100%, I told you, no, if risk weighting assigned by ECAI is less than 100%, then 25% additional risk weight to be assigned as applicable normally. For example, AAA, you will give only 20%. Now, if it is NBFC other than priority, 20 plus 25, 45% risk weight you have to keep. Then loans to NBFCs which are eligible to be classified as priority, the additional risk weight of 25% is not applicable. If you are given a loan to NBFC which you can classify in books as priority, AAA means only 20%. You need not keep additional 25% over that. So all match correctly. Question number 17, answer is E. All match correctly. So only two cases changes have taken place. I explained. Why I explained? I explained other cases of risk weight also, particularly the risk weight of other things, but in the housing loan risk weight. Very, very important. How the margin is fixed, why the margin is fixed like that. So with regard to that, one more point you will see. Question number 18. Bank has kept a risk weight of 50% for the housing loan sanctioned on 10/5/2023 for a loan amount of rupees 25 lakhs. What should be the LTV ratio of this loan based on the options given below? 75%, 70%, 95%, 85%. Please see the question number 18, sir. Bank has kept a risk weight of 50% for a housing loan sanction on 10/5/2023 for a loan amount of 25 lakhs. What is the risk weight? 50%. What is the loan amount? 25 lakhs, sir. Okay, let us see. Housing loan. Sorry. Sorry. That is not going. Okay. So housing loan, how much we'll see? Housing loan, how much, sir? Housing loan, 25 lakhs. Risk weight is 50%. Bank has a housing loan 25 lakhs between those two categories, kept a risk weight of 50%. Okay. So bank has kept a risk weight of 50% for a housing loan 25 lakhs sanctioned on or after 1/4/2023. Keep that in mind. Housing loans, individual housing loans sanctioned on or after 2023, bank has kept a risk weight of 50% for a loan quantum of 25 lakhs. So what should be the risk weight? The risk weight should be more than 80% or less than or equal to 90%. Anything you get for more than 80%, less than or equal to 90% should be the correct option for you. So bank has kept a risk 50% housing loan sanction 10/5/2023 for a loan amount of 25 lakhs. What should be the LTV ratio of this loan based on the options given below? Anything more than 80, less than or equal to 90. Anything is there? Yes, 85% is there. Question number 18, answer is D. So these are all the probable questions they asked in the previous years also. From there also I picked up some questions. So question number 18, answer should be D. So question number 17 and 19 are direct questions. This is somewhat interpreted questions. If you know the subject, you will answer. Then question number 19. What is the risk weight to be assigned for ECGC guaranteed accounts? Nil, 50%, 75%, 20%. You know for ECGC, 20%. So question number 19, question number 19, answer should be D. Okay, so we'll go to the next slides. Okay, these things we already discussed. The longer duration, what is a long-term claim, what is a short-term claim, how the long-term claim is rated, what is a short-term claim is rated, everything you know. Okay, if they ask any question, you should not miss it out, sir. Okay, stock loans I told you, then foreign sovereign also I told you. Now, there is a concept. Bank has come out with a concept because Cgtmsc has given a guideline. So wherever there is a change in your circular, wherever there is a change in procedure other than your internal, your systems and procedure with regard to loans, etc., deposit, either Reserve Bank of India will bring out a master circular. Based on that, bank will issue a guideline. For example, loan documents to be released within 30 days. Or now the penal charges are being revised. So Reserve Bank of India will bring out a guideline. Based on that, bank has to place a note to board of directors. After getting the board's approval, your HO circular will come. That is the guidelines are always. Similarly, Cgtmsc has also come out for a guideline with regard to claim, with regard to informal micro enterprises. What is an informal micro enterprises? So HO circular 101/24 and the latest circular which has come on this is maybe 2-3 weeks back, 597/24. Informal micro enterprise IME which are exempted from GST regime. So they are all informal micro enterprises. All informal micro enterprises registered in Udam Assist Platform UAP. Not in Udam platform, Udam Assist Platform, Udam Assist Platform, UAP are eligible to be covered under the Cgtmsc for loan amounts up to 20 lakhs only. You know, Cgtmsc is available up to 500 lakhs. Cgtmsc is available up to 500 lakhs for informal micro enterprises. For informal micro enterprises, it is available credit facilities up to 20 lakhs. Only one guarantee coverage, 85%. Not like northeastern region, this region, like that. No, it's not that. So only the maximum guarantee coverage is 85% of the loan amount in default. NPA, no? What is the loan amount in default? So what is the standard rate for the guarantee fee? Credit facility up to 10 lakhs, 0.37%. And above 10 lakhs, up to 20 lakhs, 0.45% is the guarantee fee for the informal micro enterprises. The idea is they're all registered in the UAP, and then the credit facility is up to 20 lakhs. The credit coverage is maximum 85%. The standard guarantee fee is 0.37% up to 10 lakhs and 0.5% up to 20 lakhs. Creation of primary security is not a precondition to cover. And then for invoking the guarantee, initiation of legal action is not required. So, you know, in the case of other Cgtmsc, for invoking the guarantee, legal action waived is permitted up to 10 lakhs. By here, you know, exposure is 20 lakhs maximum. Up to 20 lakhs also, legal action waiver, that is not a precondition for invoking the guarantee with regard to micro enterprises. This is with effect from 14 to, this is with effect from 14 to 2024. Okay. What is told in 597/24? These 2 points are told, sir. The enterprises registered under UAP are eligible for coverage even without any declaration regarding exemption for GST exemption. Declaration of GST should be submitted by enterprises which are obtained Udam registered number URN from URP of Ministry of MSME, Government of India. These two things have come in 597/24. Okay. Now this is the thing, additional thing. We'll go through it. Question number 20. Which is not correct with regard to Cgtmsc cover for informal micro enterprises? So 2 minutes you heard now. Now you tell the answer. micro enterprises which are exempted from GST regime as per HO Circular 101 and 597/24. Registered with UAP, yes, it's a correct answer. For credit facilities up to 20 lakhs, correct. Maximum guarantee cover is 85%, correct. For invoking guarantee, initiation of legal action is waived up to 10 lakhs. No, sir, that is not correct. For initiation of invoking guarantee fee, guarantee cover, initiation of legal action is not required, irrespective of the amount, because maximum amount is only 20 lakhs. This 10 lakhs in only in all other cases. Okay, question number 20, which is not correct. Point number D is not in HO circular. Point number D is your answer for question number 20. Okay, then another important question, change that has come. Okay, this we have seen. Okay, this also we see. Here I have not given the question. You see, maybe for higher levels, no, 3 to 4 or 4 to 5, you can see. Delegation of sanctioning credit, CRE exposure. Okay, CRE exposure, commercial real estate, you know. For sanctioning loans under CRE, commercial real estate exposure, collateral security of residential commercial property to be taken besides the primary security. Okay, besides the primary security, we are taking them as a security. Besides, for example, big shopping mall is constructing, or ship cinema theater is whatever it is. So it is a commercial real estate exposure. Various definitions are there, various calculations are there. Based on that, let us assume you are classifying exposure as CRE. When you classify an exposure as CRE, that is besides the primary security, that property for which you are sanctioning, you have to finance. Besides that, additional collateral also to be taken, for that commercial real estate exposure. Now, what is the guideline with regard to how much additional collateral you have to take? We are going to see now. There is a change in 103/24. Then that is updated in 257. 257 is a delegation policy for the year 24-25. 539 is a recent changes in the delegation credit sanctioning up to 36/2024. Everything is covered here. 539, if you see also, you will get. For sanctioning loans under CRE, commercial real estate, collateral security of residential commercial property to be taken besides the prime security. Okay, sir, good. The distressed sale value of the collateral should not be less than the loan amount. So what should be the collateral value? The distressed sale value given in the valuation, not the market value. The distressed sale value of the collateral should not be less than the loan amount. Not applicable for loan CRE under schematic lending. This is the existing guidelines. Now, the distressed sale value, the collateral, is linked to the risk grade of the borrower. See, so far risk grade has not come into the picture at all. So risk rating has not come into the picture at all. So what loan you are going to give? You have to give 100% collateral. The collateral value should be to the distressed sale value you have to take for the loan amount. Now they are giving who is the sanctioning authority. And if the risk grade is this much, risk rating is this much, if he brings the collateral to the extent of distressed sale value this much, who is the sanctioning authority? There is a change in the delegation for sanctioning. That is why it has come in the delegation of power. So if the risk rating borrower is low and he is bringing 100% collateral is to the distressed sale value of the property. He is bringing 100% distressed sale value of the property to full extent, then the respective sanctioning authority can sanction. He is having the power to sanction the commercial real estate, he can sanction. For a low risk borrower, if the collateral is going to bring not so far, it is 100%. The distressed sale value should be to the full extent of the loan amount. Now, if he brings full extent of the loan amount, then respective sanctioning authority can sanction. He can also bring less than the distressed sale value also as a collateral. So, if the distress is less than 100% up to 75%, CGM, GM, COs, HOCAC to permit the loans. And if less than 75% up to 50%, EDCAC, less than 50%, CAC of the board. So, the crux of the circular is commercial real estate exposure, besides the prime security, collateral also to be brought by the borrower so far. What is the value of the collateral? The collateral should be 100% to the value of the loan. The value should be in the valuation report should be the stress-free sale value you have to take. Now, even less than 100% collateral, if he brings the less 100% of stress to sale value, depending upon the risk grade of the borrower, various authorities are having the power to sanction the loan. If it's 100% collateral, it is respective sanctioning authority. Depending upon the less than 100%, various sanctioning authorities are given in the circular. So that depends upon, sorry, oh, it is not going, okay. Oh, 1 minute, sorry. Okay. So if it is a normal risk borrower, so collateral security 100%, so 100%, and you use the sanctioning authority, it has come less than 100%, less than previous, less than 50% you can go, here less than 60% who has to go, where it has to go, it is there. Moderate and high risk customers, so there cannot be 100% collateral only to be brought and the respective sanctioning authorities to sanction. So this circular is with regard to commercial real estate collateral. So the collateral is less. So far it is 100% and the stress sale value is the criteria. Now if it is less than 100%, depending upon the risk rating of the borrower, various authorities having power in the bank to sanction the loan. Okay, sir, good. Then okay, this point we'll see. Revision in service charges, HO Circular 134/24 with regard to revalidation charges for working capital and term loan. You know, working capital, once sanction is given, up to 3 months it is valid, and if it is term loan, up to 6 months it is valid. So if the party is not, even when the loan documents are executed, even though the party is not availing, even though the loan documents are executed, it is equivalent to availing the loan only. Okay, so when you have to do revalidation, if the loan documents are not registered, not executed, or that is in that case, the party has not come at all, even after you sanction the loan. With regard to working capital, up to 3 months it is valid. In up to term loan, it is 6 months. One time you can do the revalidation of the loan. So when you do the revalidation, any charges to be collected? Yes, so far, even before 134/24 was released, charges to be collected. But there, they have not given the maximum cap. Now, in this circular, the maximum cap is being given earlier up to 5 crores. So, earlier, so you have, irrespective of the sanctioned loan amount, you have to charge 50% of the applicable processing charges for working capital and 30% of applicable upfront fee for term loan. Irrespective of the loan amount, 50% and 30%, no upper cap. Now, depending upon the loan amount, they are given the charges and the cap also. So up to 5 crores, 50% of the applicable working capital, 75,000. Here 30%, 75%. Like this, depending upon the loan quantum, the revaluation charges you have to collect for working capital and term loan, cap limit is given, as well as depending upon the loan quantum also. So you have to collect the maximum cap is given here. So earlier that was not there. Now, under this circular, one more point is also given here. Extension of guarantee of rupees 5 crores and above, commission for extended period to be collected for completed months. Part of a month to be treated as a full month. Earlier, it was completed quarter. Now, for less than 5 crores, it is a completed quarter. So here, in this circular 134, revalidation charges has come for working capital and term loan. The validity period is 3 months and 6 months. So here, if it is not, loan documents are not executed or whatever it is you say, when you have to revalidate the sanction, respective sanctioning authorities can do the revalidation. In that case, depending upon the sanctioned amount, and charges are given for collection charges, and here the maximum cap is also given. Maximum cap is up to 15 lakhs you can collect if it is more than 100 crores. In this circular, the extension of guarantee of above 5 crores and above, commission to be collected in the fraction of a month. Earlier it is a fraction of a quarter. Less than 5 crores, fraction of a quarter. That's all, sir. Now, question number, that is the next point is compensation for customer for delayed rectification, updation of credit information. Say, customers, let's assume that they are seeing their credit information report from the credit information company. You are having 4 credit information companies. Okay, from the credit, that is the retail loans, no, you do the credit information CIR from the credit CACs, credit information companies. So the credit information companies should make available the full credit information report to the customers free of cost in a calendar year. So if I click the website of C, that is CBIL, so it will take me to a place where full credit information report free of charge. There I have to log in, give my credentials. It will give me full credit information as on date, so free of cost. So every credit information company in a calendar year, that is from January to December, make available the full credit information report free of cost to any individual in the country. Suppose let's assume I am clicking and seeing. So I am finding and one of my accounts with one bank is showing as overdue. But I have not availed any loan at all from that bank. Or I have availed or closed that loan long back. So nothing is wrong with me. So I can approach the bank because full credit information report, I will get the name of the bank also there. So I will approach the bank or I can approach the concerned credit information company. I got to send a mail. Or in Canara Bank, I got to log in CPGRS. If I avail the loan in Canara Bank, I got to log on CPGRS. So I have to give my this one. So I have not availed any loan, but it is showing overdue 3 months in Canara Bank. Kindly rectify. Or I may approach the credit information company also. If I straight away approach Canara Bank, so this is happened in my loan account. So Canara Bank has to check it and send me a letter within 21 days, calendar days. From today, I sent a mail. From today, within 21 calendar days, Canara Bank has to send me a mail stating that we have either rectified and we have informed the credit information company to update. Or Canara Bank will state, no, you are wrong, we are correct. Within how many days Canara Bank has to tell? Within 21 days. If Canara Bank is after telling to me, Canara Bank, because I have directly sent the letter to Canara Bank, Canara Bank will inform me. If it is wrong, Canara Bank will give the intimation to the CAC also. Within how many days credit credit institution, CAE means credit institution, Canara Bank. So within 21 days of receipt the complaint from the customer, Canara Bank has to either give a reply or rectify it. So Canara Bank will send it to credit information company. Please update it. Credit information company has to update it within next 7 calendar days. So if the credit information company, so the entire process to be completed within 30 days of receipt of the complaint from the customer, either to the bank or to the credit information company. Suppose if I have sent the report to CBIL, CBIL will inform Canara Bank. Within 21 days, Canara Bank has to inform the CBIL. CBIL will update it or it will inform me. The entire thing to be got done within 30 days. If it is not done within 30 calendar days, the customer has to be compensated at the rate of ₹100 per day. That is the crux of the circular, sir, 318/24. I will read it again. Credit institution. Credit institution means the bank or the financial institution which is giving the loan. Credit institution to send SMS email to customers while submitting information to CACs regarding defaults days past due. For example, Canara Bank is going to send an information. So up to what, beyond what level you have to inform the CBIL, etc. is there, no? When Canara Bank informs about my default or past due to the any credit information company, I should receive an SMS or email from Canara Bank that you have been informed as a past due defaulter to the credit information company. I should get. Canara Bank should make the provision for that. Customers consent for generation of CAC report to be obtained as per the format by CAs. So suppose I am applying for a loan, you want to take my credit information report, you have to get a consent from me. The format may be there along with the documentation. I have to sign and give to, I don't have any objection for you to downloading my credit information. CAs credit information company to send the SMS email to customers when their CAR is accessed. So now role is also for the credit information company. Whenever Canara Bank is generating a credit information report about me, immediately the credit information company has to send me a mail also. So credit information, that is so and so bank has access to your credit information report. These are all the guidelines, sir. Then complaints regarding CAR to be lodged with suppose if any customer wants to lodge a complaint with regard to the credit information report within Canara Bank, they have to lodge in CPGRS portal with effect from 24/2024. You have various portals, no? Depending upon various types of complaints, you have to lodge in various portals. CAs means credit institutions. Credit institution means financial institution. Credit institutions to have a nodal point of contact by credit information companies for all customer complaints redressal. In our bank, which is the nodal point, it is all CA. There is a section in RLPF wing, recovery, legal, and fraud prevention wing. RLPF means recovery, legal, and fraud prevention wing. In that wing, there is a section called all CAC section. So the credit information companies has to contact the all credit that is CAC section with regard to any complaint with regard to the CIR about the customer. Any change in nodal point, okay, this you leave it. CAC is to update the data of customers received from CAs within 7 calendar days of receipt. If Canara Bank updates and sends it, I have to update in the CAC. If I am CIBIL, I have to update within 7 days. In case of rejection, CAC is to inform the CAs reason for rejection within 7 calendar days of receipt. CAC is to provide easy access in their websites, free full credit information report once in a calendar year, January to customer, January to December to customers. If complaints by customer not resolved within 30 calendar days from the date of initial filing of the complaint, either with the CAC or with the CIs, a compensation of ₹100 per calendar day to be given to the customer. CAs to send the corrected data to CAC within 21 calendar days from the date when CACs are informed of the inaccuracy of the data, either by the customer or by CAC. Banks have to send within 21 days. Then credit information companies to update the corrected credit information in the remaining 9 calendar days. So within 30 days, the entire process to be completed. If the complaint is rejected, the reasons to be informed to the customer within the timeline. Complaint to be resolved within 30 calendar days. The date of resolution is the date when the rectified CIR is sent to the complainant by CAC or by CI to the postal address or email ID provided by the complainant. Compensation to be credited within 5 working days of resolution of the complaint. So within beyond 30 days, you have taken, let's assume, to give the resolution and you inform the customer, then compensation to be credited to my account, whatever for the number of days within 5 days of resolution of the complaint. If the complaint is resolved after 30 days, customer ID and with nil or valid mobile numbers are available. Customer IDs with nil or invalid mobile numbers are available. Business object report 371038. Okay, sir. Now we'll see the question. Now, mostly now it may be 1 o'clock over there. I want to complete this. Okay, question number 21, sir. Question number 21C. Okay, sir, with question number 21, I will try to stop it today because I have some engagement. I already told Mr. Another question. So this is with regard to updation of credit information companies, which is correct with regard to updation of credit information by credit information companies received from credit institutions as per HO Circular 318/24. I'll again read this question. Which is correct with regard to updation of credit information by credit information companies received from credit institutions as per HO Circular 318/24. CICs, credit information companies, to send the SMS email to send SMS email to customers when that CIR means credit information report. CA means credit institutions. CACs means credit information companies. Okay. The CACs to send SMS email to customers when their credit information report are accessed. Correct. CICs, credit information companies, to provide free access to customers in their websites, free full credit information report once in a calendar year, June to December every year. Year before or year before last, they asked the question, which is not correct. They put their full credit information once in a financial year. So that option should have been taken there. That is why I have given that option also here. In a calendar year, that information should be available free of cost. That is also correct. Point number 3. When CAs, credit institutions are informed about the inaccuracy of the data either by the customers or by credit information companies to send corrected data or reply within 21 calendar days. That is also correct. CACs to update corrected information within 9 calendar days. That is also correct. If complaints received from the customer is not resolved within 30 calendar days, compensation of ₹100 to be paid within 5 days of resolution of the complaint. Correct. So your options are A, 2 to 5 all are correct. B, 5 only is correct. C, except 2 all are correct. Because point number D, 1 to 5 all are correct. So here 1 to 5 all are correct. So your answer for this question should be 21 should be answer is D. Okay, sir. Now it's 1 o'clock here. That is, sorry, it's 1 o'clock over there. It is 9:30 morning here. I want to close the session today 1 o'clock. Next class onwards, I'll take up to 1:30 if I am given the morning session. Thank you very much for the patient hearing. My WhatsApp number is 98403-74662. My WhatsApp number is 98403-74662. Any of you have any request or anything, doubts, you can put it in the WhatsApp number. Since I am away from India, I'll be coming back only after the exam. The time zone difference will be there. So please send your request through WhatsApp. I will try to address it. And friends, afternoon session very, very important. Mr. Ravi Kumar, that is one of the leading faculties of the current faculties in your Manipal setup from Hyderabad will be taking the session and will be discussing you about the importance of getting more marks